Today we're breaking down the $53,047 a month portfolio worth over $1.6 million of Perry from the PIIverse. We are breaking down his entire portfolio by company structure. Use the chapters below. So we're going to go through Hamilton ETFs he owns, Harvest, Evolve, Global X, Roundhill, NichoCrypto, Defiant, and YieldMax. Perry, thanks for being here. Let's start with Hamilton first. You own HYLD. You have 1,750 shares, worth quite a bit. And then you also have HDiv, and that's your Hamilton. HYLD and HDiv. Why do you own those? Walk me through it.
Yeah, thanks. First of all, thank you very much for the invitation for the interview. It's an honor on that. So the way I want to talk about it is the way that the groups are. You've mentioned Hamilton. First of all, Hamilton is actually an emotional sweet spot for me because I actually got into passive income investing and using derivatives-based income investing because of Hamilton. So
Same,
like,
man.
yeah. So when I go back in 2023, when I actually started building this new strategy, I was basically doing my work before I retired, and over on the corner I have a TV right over there, and it basically had BNN News Network on, Business News Network, and I saw all these HMAX commercials, and I was like,
yeah,
what are these things? So I have a little sweet spot for Hamilton because they're the ones that actually got me into it. As you can see, HMAX is not in there anymore because over time, as I matured and evolved my portfolio, I saw there was too much overlap between HMAX and Bank and BKCL. So I basically decided to take HMAX out. I'm holding HYLD and HDiv because they are part of what I refer to as my core moderate and high yielding portfolio holdings. Again, if I take a step back on my portfolio, you said it was 1.6 million. About 250,000 of it is not even covered call ETFs. I'm a hybrid investor, and therefore about 15% of it is not even covered call ETFs. They're just growth stocks. Of the 85% that are my income portfolio holdings, I break it down to about 50% that's considered moderate to high, stable NAV, stable income producing covered call ETFs. And then the other 50% are what are my income generator, my juicy ones, the ones that are actually saying, okay, Perry, you're safe. You're bringing in some good income. So if we have bad market days, you're still covered by those guys. The other ones are used to actually really bring my portfolio's monthly income up high, as you've mentioned. So the reason I brought that up is my Canadian covered call ETFs generally are my core, and amongst Hamilton, HYLD and HDiv are the stars in my opinion there. I like HYLD because it gives me that US exposure, and I like HDiv because it gives me that Canadian exposure, and they are both extremely stable on NAV and extremely stable on income. So that's why I hold them. They are clearly not yield monsters, as you can quite clearly see. I've just got my numbers up right now. They generate anywhere between 12 and 10% yield, so they're not really screaming at me. But again, they're part of my core base of stable NAV, stable income, and that's why I actually have those two selected out of all the Hamiltons.
HDiv was one I was looking at. By the way, I got into Hamilton was my sort of gateway drug into covered calls as well. So
Yeah.
I'm with you on that one. So I used to own HYLD. I'm actually going to buy it back now because I need a core holding as well. But HDiv is the one I've been looking at because they're also highly stable. I think they actually increased their distributions from what I remember.
They have
slightly
HYLD and HDiv. They don't do anything in any dramatic way, but when they move up, they'll say, "Oh, I was at 17, now I'm at 17.1." Like they go up and down really slowly, but they are going up, which is nice. So
it's a nice health indicator, and I think the way you're using it is how it's supposed to be used. It's like a core-ish holding, a stable holding. You're supercharging this with your high yield ones. Okay, so Hamilton, I guess when we view it in your portfolio, so HYLD and HDiv are the two that I actually look at too. So we're aligned there. We're using them for the exact same reasons as a just low to moderate yield, but highly stable They don't get affected by NAV erosion as bad.
At all.
And
They don't
at
get
all.
affected by NAV erosion. No,
Okay,
they generally.
there you go.
Yeah, and that's a good thing you brought up the idea about NAV erosion. There's this misconception that all covered call ETFs generate NAV erosion. That's absolutely 100% false. Anyone that says that doesn't know what they're talking about. NAV erosion only generally happens amongst the most highest ultra yielders that are really pushing the envelope on yield. And then when they do that, when you're really, it's like running an F1 Formula racing car. When you're pushing the envelope, things will happen. If you're driving your car to church on a Sunday morning, chances are you're not going to be having any engine issues because you're generally quiet. So to me, HDIV and HYLD, and we're going to talk about some of the others as well in my conservative side, you won't see NAV erosion. NAV erosion means that the NAV is constantly dropping down. If you looked at long-term trend, you would always see it going down, down, down.
Yeah.
You will not see that on things like Hamilton and Harvest. You will see them go up and down, but that's no different than Tesla going up and down. They just have highs and lows. As long as they're trading in a price box, they are not NAV eroding. Yeah.
That's a really good point. Price box, price range. But yeah, they stay within this range and they're not really going out with it.
Yeah.
That's, gosh darn it. That's a really good way of putting it. I haven't heard
Well, and
anyone
the other
sort of
part
talk
about that too, Gary, is the fact that not only in the nice price box or price range, which again is indicative of a very healthy covered call ETF, but they're at the peak of it. Like I actually on my spreadsheet chart where they are in their 6-month cycle, and they're one of the few that are actually at the very top of their cycle. Like they are on the top of their price box with regards to both HYLD and HDIV. So not only are they in the price box, but they're also at the top of their price box.
Yeah, nice. I have all your information in front of me. I don't want to give, I'm going to let you talk about what you want to make public. So I'm going to let you give out percentages and stuff. I'm just going to tee you up, and this is for the viewers. I'm just going to tee you up with the names of all of these and you can go off. But then if you want to give shares or values and stuff, you go ahead and do that.
Yeah, sure.
Or percentages because people love that stuff anyways. Like they kind of want to know where to allocate. So like if you have to take, before we move on, Hamilton is roughly, we're just going to say Hamilton. We're not going to say HYLD, HDIV. Hamilton is how much of your portfolio do you think?
So first of all, don't worry about, I apologize. You just don't have the information. I have no problem showing my yield. Or my holding weight. If you go into Blossom, for those of your audience that's in Blossom, if you look at my portfolio in my profile, you will see actually the holding weights of everything. For HYLD and HDIV, so I have two weight settings. I have one that includes my stocks and ones that don't include my stocks. I'm going to give you the percentages of the ones that don't, if I exclude my stocks. So of my income generators, HYLD makes up 1.7% of my portfolio, and Hamilton makes up 2% of my portfolio. So they're not big ones. They're not big screamers.
But these numbers are not modest though either though. Let's move on to Harvest. So we're calling it bucket number 2. Number. That's just how I'm going to lay out this. So in the titles below, guys, it'll be bucket number 2. Harvest. You have HPYT, HHIC, HHIS, MSTE, CYNE, PLTE. I own out of this HHIS, MSTE. And I was thinking about HHIS. So let's break them down one by one. HPYT, nothing's popping in my head right now. Which one's that?
So HPYT is my token non-equity covered call holding. HPYT is bonds and treasuries. It's a long-term treasury, so it's 10-year bonds. It has not been doing good, but that's a lot related to the markets in general, that bonds are not doing good themselves. That being said, I've still held on to HPYT. It actually, sorry, I got to give you my percentages on this one. I hold its current market value right now is 52,000. So I do hold a pretty good percentage of it. It only has about 11% yield, and it makes up 3.5%. So it actually makes up a good portion of it. And the reason I do that, Gary, is because it's my only non-equity holding covered call ETF. So I do want to have exposures to the bonds. The nice thing about it is that even though it has eroded, and you could, if anyone calls up HPYT and they look at its chart, it does look like it's eroding. I'm not that worried about it because even though it's eroded in NAV, it's actually held its monthly income distributions very stable. They've only had one drop since it started. Like I bought it at 11 and I think it's right now at around, let me just look, 8.98. So it has dropped, but it's only had one NAV decline, or sorry, one distribution
One
decline.
distribution decline.
Yeah, it's and so therefore, would I like it to go back up? Well, I can only do that if the market's changed to make it do that. So it is, I hold it because it's my non-equity treasury cover call ETF.
If it went up and let's say you got back to break even for buy-in price, would you start trimming that position a bit and move it somewhere else? Because you bought
No,
it for stability. If it was bonds, you probably bought it for some level of stability because it's first off non-equities, so diversification, right? So
it's
stability through
diversification.
diversification, but
Yeah,
stability through diversification or safety through diversification. So
yeah,
because of that, even if the price goes up, you're keeping it because your reasoning is for
absolutely.
that.
Yeah, and
Yeah,
you bring
okay.
up, there's 2 points. So just so for your audience that doesn't know my portfolio, if they actually go to my channel, they'll understand my whole strategy because I actually have a video that explains my entire strategy and how I work. Um, I believe extremely, and you can obviously see from from my portfolio, I believe in very high diversification. Like I don't believe in any holding more than 5% of my portfolio, and a lot of times it's less. That's why I actually have 30 ETFs because a lot of my cover call ETFs make basically only do 2 or 3% of my
Okay.
portfolio. Um, and when I talk about diversification there, I want diversification in many different elements, like bonds versus equity, Canadian versus US, uh, Harvest versus Hamilton. I look at as many different elements of a diversification as possible because it basically mitigates my risk if any one of them goes bad for whatever reason. So you are right. With HPYT, I don't think I would ever trim it because it's one of those that holds the non-equity portion of my portfolio. It would never be one I would trim.
Um, I guess it's a kind of a question. If you found an equivalent that did the same thing, non-equity bonds, but just like perform better, then would you consider? You just find
Well,
something that
actually,
performs.
I
Yeah.
made that decision already, Gary, because there
Uh,
was 3 candidates. I can't remember. One was from an American company that I can't remember what their name was, but Hamilton has one as well called HBND, I think, or H bond, whatever. I really at the time was going to do both of them, but I already
yeah.
consolidated my position in that. If for some reason Hamilton's HBND was, looked better than that, I'm more of a buy and hold investor. So
Uh-huh.
chances are I wouldn't actually sell it to go somewhere else. I would actually add
Uh-huh.
HBND to HYLD if I felt I needed to have more holdings. But I'm not the kind of person that, for the most part, I'm not one that will jump from competitor to competitor,
Yeah.
unless there is a strategic reason why. Like maybe I'm overweighted on one covered call ETF, and I'll say, okay, I'm going to trim it down because it has some good gains, and I have
Yeah.
done that. So my strategy has done that on a few occasions where I've actually trimmed gains. I won't exit the position, but I actually trim gains, and it was a couple. It was actually one of the two or one of the harvests, PLTE, which has experienced. I've gained so much from it that I actually took the gains out and actually used it to buy other cover call ETFs.
Yeah. That makes
Yeah.
sense.
Yeah.
I have a quick question. Where are all these spread across? What accounts do you hold these in? Everything from RRSP, TFSA, even do you put it in non-registered? I'm more curious about non-registered because that's where I hold mine because my
Yeah.
TFSA, RRSP, and everything. Do you hold it in non-reg or that's just a tax nightmare for you and you don't bother?
Okay. I'm a lazy investor, Gary. So
Yeah, yeah,
I
yeah,
don't
yeah.
hold any in my non-reg. And the only reason I don't hold cover calls in my non-reg, I did at one point. When tax time came, I hated the T3s, the T5s, the ACB recalculations. And again, I know I could have addressed that by getting an accountant and having my
Yeah,
accountant
I
talk
use
to
an
my
accountant.
broker.
That's all. I'm not doing any of that. Yeah,
Yeah. Yeah, I know. So if you did that, I guess I could have turned around and said, you know what? I'm going to generate income in my non-reg. And there actually are, from what I understand, there are tax benefits in actually holding the cover calls in your non-reg because
yeah,
that ACB is actually meaning you're deferring your taxes by actually reducing your ACB until you sell it, and then you're going to get hit with a big capital gain. But if you're a buy and holder, you're not going to worry about that. So No, I don't hold anything in cover call ETFs in my non-reg. Only my pure growth stocks, Athabasca, HMR, and PEI are in my non-reg. All my cover call ETFs are in my 4 RIFs and my 2 TFSAs.
Yeah,
And
okay.
and that a related question, sorry, I'm going to ask because I get a lot of people on my channel asking all these kind of questions. I don't, there are some people that believe you should put US covered calls in RSPs, not in TFSAs. I think they're looking too myopically at it. It's not that, it's like pay me now or pay me a lot more later. So I don't believe in that strategy of holding US covered calls only in RSPs to avoid the 15% withholding tax, because you got to think about it this way. Yeah, you're going to be charged 15% withholding tax if you bring it in, if you hold it in your TFSA. But if you hold it in your RIF, when you actually withdraw those gains, you're going to be charged at 30% income tax rates. So there's no avoiding the tax, man. You're just deferring
Yeah.
it, right? So yeah,
Yeah, that's a good point.
yeah.
Um,
Sorry,
okay,
that
so
long answer to your question there.
no,
So,
no, no, thanks for that. I appreciate it.
yeah,
All right, so we have HPYT.
yeah,
So that's your bonds. That's there for diversification. Now, HHIC
it's
is
new.
the one I'm is that what do you think of that one? I
Yeah,
haven't done any breakdowns on my channel about it, so I haven't done thorough research. I do a lot of research when I do a video like for breakdown. Since I
yeah,
haven't done a video breakdown, the research hasn't really happened. But it's one I've been considering because you see Canada, I go
yeah.
and I'll tee you up with people always go, it's HHIS, but for Canada. Is it a 1-to-1 like that, or is there some clear
Yeah, so
differences?
HHIS is the rock star right now amongst the harvest ETFs. I mean,
Oh yeah,
anybody is going to buy
yeah,
HHIS because
yeah,
it gives you both great yield from a Canadian cover call
and
ETF. Like,
growth.
how often do you get something that gives you that kind of diversity under one underlying and gives you 25% yield? I mean, that's awesome. So
Yeah,
I don't blame Harvest for being really successful with HHIS. I liked being a Canadian, I like the fact that they introduced a Canadian version of it. I don't have as much excitement with HHIC, but again, similar to HDIV and HYLD, I did want to actually have something that was an umbrella of single stock ETF similar to HHIS, but running on Canadian companies like CN and Shopify and stuff. So I did dip my toe into it. I have 1,200 shares in it already. Um, I there's a lot of competitors coming around though. And again, I know Adriano can quote them off like the back of his head, but there are from 9 Points and Evolve, and others are coming out with like there's one called Maple that's just coming out now. Um, I'm going to sort of keep my toe in the water with regards to HHIC, but I'm going to see how their competitors are that are coming out from 9 Points and that, and see if I like, you know what, maybe this other one's a better one. Like I know with 9 Points, they have a lower MER. So and have a
that's
little
a
bit
big
higher
one.
yield. So I might, again, but here it goes again, what I've said, Gary. If I make that decision, I might first start out by just adding 9 Points all in one Canadian, as opposed to actually switching away from it. And then usually what I do after about, say, a year of holding both of them, and I'm actually going through a rebalancing one on something similar to that right now. After about a year of holding them, I sort of evaluate the two of them and I sort of say, you know what, is there value in holding both of them? Maybe I should basically say, you know, the clear winner here is this one. So maybe I'm going to move them. If I can trim some gains out of it at the same time, I'll use that to buy higher yielders and then consolidate this into one Canadian all in one position.
That's the best way to do it. I'm thinking more like you. Um, Add to positions, especially when you're trying to figure out, there's so many new ones coming
Oh,
out. It's
I
like
know.
you can't just like keep
My head's
bandwagon
spinning.
jumping. It'll be crazy. And like your portfolio, it just become a mess if you're constantly like selling all the shares here, moving it here. It's like,
Yeah.
I get it, add it. I like the idea of letting it run for a year and
Yeah.
then waiting till there's like a clear winner. Like,
Right.
wait a second, this is obviously better. Okay, this makes sense.
Yeah.
If there's
Yeah.
no clear winner, I'd probably if they're both as winners, just keep both, I
Just
guess.
hold
Like
them. Yeah.
whatever.
Like at the end of the
Yeah, yeah.
day,
Why
what's
not?
a dozen of one or two half dozens of another? Like at the end of the day, if as long as they're
Yeah.
sort of delivering, the nice thing about that, Gary, is that if there is no clear winner, and I'm actually having I'm going to redo this video that basically I'm doing a major rebalancing on a US one, and we'll talk about it later. But the struggle I had, and I might likely have it with this one too, like HHIC versus the 9-pointer, the Evolve one, will be that the chances are they'll be like so close to each other that why not keep them both? The nice part about it is it feeds into my third goal of my 3 primary goals of my portfolio, and that is diversification to reduce risk. So why not
Yeah.
hold 2 of them? And that maybe Harvest is having some issues or Evolve is having some issues as a fund manager. At least you're protected against fund manager diversity, right? So
Yeah.
why not keep them both, right? So yeah.
That's an interesting point. Fund manager diversity. I like that.
Yeah.
Okay, so HHIC, now HHIS, everybody's rock star in their portfolio. I hold it. It's the one I'm gaining on it, which is, so I get the good yield, but I'm up a few $1,000s.
Yeah.
I think my position is, I don't know, like $50,000 or something in HHIS. I don't know what it is. I can pull it up, but nobody cares about my portfolio. They care about yours. But yours is quite large. Yours is about double mine, a little bit more than double mine. Especially if you bought
position in
yeah.
that one. I have 8%
Yeah, and
in that one. It's one of my.
What was your? Do you mind sharing your average share price? What did you get it for? I got it for a decent
I bought
price, and
in.
I'm
Let
up.
me just find out here. My HHIS I bought in at $12.99. I'm actually pretty much level because I'm looking at my profit loss on it. The NAV is
Yeah.
0.5, so I'm basically up 0.5%. So it's about because it's at 13.05 right now, and I'm at $12.99. So I'm literally at its break
Yeah.
even. Is what I'm seeing.
I got it at 11.94.
Ooh,
So
yeah, that's nice.
last time I tallied up my position, I have $51,951 in it.
Okay.
So I'm up. It's kind of a weird, for me, it's like kind of I'm a growth investor and a value investor,
Yeah.
primarily a value investor. So I'm just picking single stocks. It's a nice feeling for me to have to like see a covered call like up in profit while also getting the yield. I know I shouldn't.
You're going to be in a big dilemma, Gary, because here's the problem. As a growth investor, sorry, I'm not picking on you here, right? But as a growth investor trying to invest in covered call ETFs, which are clearly income focused,
it feels weird.
It must really be baking your noodle because as an income investor, I don't worry about it. It's like, yeah, okay, the NAV's up, it's down. I'm focused on the income. For you, there's a pleasure and a hate if you see your value up and down, right?
I don't want to take up the audience's too much time, but I feel my brain changing. Like I feel like there's muscles being worked that haven't been worked in a while.
Yeah.
It's like, oh, like it's that. It's like my brain hasn't had to think like this, so it never developed in that way.
Yep.
So my brain is developing and looking at investing in a different way.
Yeah.
Like, you talked about, hey, if it just stays within a range, you're happy.
Yeah.
You would never think that way as a growth investor.
No, as a growth investor, you'd be pissed off. Sorry for the
why is it staying
there.
in a range? Why did I invest?
Yeah.
But for me, it's like understanding the dynamics of how it works. I go, no, that's a good thing. Yeah. So it's actually supercharging my investment ability. It's I'm going to quote this wrong, but Warren Buffett says, and people hate it, by the way, when I quote Warren Buffett, they're like, who do you think you are, buddy? Stop quoting this guy. But it's my number one reference. He's right there. Yeah. He says something along the lines, it's like, know how all the investment styles work, know how everything works, learn about every industry, do everything.
Right.
Don't do it yourself, but learn it all because all that knowledge works. Thing is, I do like spending my own money. I come from an advertising background, so I learn through testing with a budget, seeing what works and doesn't work, and then you extrapolate. So for me, this is very much an advertising thing. My brain's comprehending it. I got $100K. I have a test budget with covered calls. I'm figuring out if I can make it work for what I personally need. And what I personally need is not to sell. I don't want to sell these positions because it's a non-reg. I want to eventually get anchored into positions and I'm like, I can hold this for 20 years. And I don't think, but they're so new, all of these, that I don't have long-term data to be like, oh, this one's been around for 15 years. I know. So I'm stuck with that as well. But let's move past me. No.
And that's funny you say that, Gary, because honestly, and this is where we're, and if you're on the Blossom community a lot, I don't like seeing it, but unfortunately with any social platform, you're going to see it. There are some really entrenched growth investors out there that just can't, they're in a mind bubble that they only see things from a growth perspective. And it's really, baking their noodles when they can't say, how can you not worry about NAV? Why are you not worried about NAV? Why are you not worried about ROI? And the funny part about it is because as a growth investor, ROI is very important, right? The biggest problem they can't wrap their head around is ROI could be income focused ROI or growth focused ROI. And then people are like, well, what do you mean by that? Because ROI is not about growth. It's about total return. And
Yeah.
I'll give you a quick example about that, Gary, why I actually don't worry about this. The very last ETF on that list that you see there is Coney, right?
Yep.
Coney, my NAV on Coney is down 64%. Guess what my total return on Coney is? Plus 29. Why?
Yeah.
Because even though I'm down 64%, it has generated my portfolio $88,000 in income. And that the growth investor, because they can't really wrap their head around that income part of it, and they only look at the growth part of it, they look at 64% down and they're like, what the heck? Why would you hold that thing? Well, why? Because as an income investor, it's generated me a yield that basically has exceeded. I'm only 3 months away from what I refer to as house money status, which means it's actually paid me so much distributions, it's paid for my entire investment already. And so I'll be in
Wow.
house money status. So it is funny you said that. You're actually exercising an area of your brain that is not used to talking about income, but you're starting to feel and understand that side of it. So yeah.
I feel people like Dragon Ball Z who've seen it, I'm leveling up to this thing
You're
called Dragon Ball
leveling
Z
up.
to like Super Saiyan. I can feel the powers, right? One thing psychologically before, guys, I'm not, I swear to God, I'm not going to talk about myself a lot. I don't want people to get annoyed.
That's okay. I don't mind. Your audience wants to hear about you.
I'm sort of talking to growth investors who, I'm in a weird position. I get shit on by all investors now because I do everything.
Yeah.
So growth investors get mad at me because I'm doing covered calls. Like the covered call guys will get mad at me because I go like, well, I like growth investing, and then I'll pick apart the nuances of covered call. I'm like, here's what doesn't work, right? I'll just tell you guys both. But for growth investor doing covered calls, this is a psychological thing, and whether the growth is the same, like Adriano, and I know you guys, you're at a plus 27, like your actual growth when you reinvest and everything, you put it back in, you're like on par with a lot of growth investors.
Yeah.
Let's say you're still not, right? I psychologically will always go, growth investing is where the actual long-term gains are.
Yeah.
With regards to what people tell me, because I have historical data to back it up, and I've been doing it for so long. My portfolio shows me that it works.
Yeah.
The reason why covered call for me and psychologically I got around it was a personal decision of, and I think a lot of growth investors do this, is we have a hard time spending money on ourselves. We have a hard time living in the moment financially. And we're so tightly wound around making sure every dollar is paying us money that we're going to use in 30 years.
In 30 years, yes.
and it's like not now. And like I say, I've had this problem for a long time. I've been, without giving away my net worth, making good money for a long time. Not a long time, for a while now.
Yeah.
And I haven't got out of the poverty mindset that I had in my teens and my early 20s, because I've experienced enough to know what it feels like to really be scared about your income. So even when I started making into those, when I start cracking 7 figures and all that stuff, I got into this thing of like, I can't spend money. I just can't. Every dollar's got to like work for me. So other than investing into my business and all that stuff, I don't spend any money on myself. Now that I have kids and a wife, I'll let them spend the money. So I'll throw money at them, but it's for me, but for internally, I can't. So it was kind of a psychological thing of like, I need to break this. And I thought this was a pathway of like, okay, I'm going to reinvest all my dividends every month. I know myself, but every once in a while, I'm just not gonna.
Right. You're just going to spend it.
Yeah. And like I think I wrote down here, my projected September dividends for my portfolio should be around $2,691, right? Because I've been buying, right? So I didn't get it on the last round, but I'll get it on the next round. I'm like, I might just like,
and honestly, this is like, I'm liking this conversation because honestly, it's a path towards where you're heading anyways. Because at the end of the day, even if you're not a FIRE, and I think everyone knows what FIRE means, financial independence, retire early. Even if you don't have a FIRE mindset and you're just saying, hey, I'm working towards my retirement being a life of ease and that, if you start actually exercising that the income should actually work, your investment should work for you, not you work for your investments. That is the difference between a growth investor and an income investor. You just said that you want your money working for you. Well, as a growth investor, you're working for your money. Because you are contributing, you are putting it in, you are taking part of your income salary and putting it into growing something that you will not consume for the next 10, 20, 30 years. An income investor sort of says, no. I'm going to have my money work for me. I'm going to capitalize my gains and turn it into capitalized income. And I'm just going to basically start using that money. The key part of doing it is to do it smart, though. It's like you need to reinvest because Yes, just like a growth investor, you want to reinvest back into your portfolio so that not only is it rewarding you by you can go buy a car or something like that, but it also makes sure that your portfolio is growing and you're actually doing maintenance on it. It's like having a car and saying the car drives me all over vacations and to the store. But if I don't put oil in it and gas and maintain it properly, the car is not going to deliver for me. So having that mindset of having your money work for you, but having a strategy where you're actually circling back, that you're feeding it so that it can keep helping you, is where your target state should end up being, right?
Right now, because you're retired, I guess you use a portion of yourself. Do you use even a portion of this to live off of, and then the rest is just reinvested, and you're just financially responsible because you just know what your living cost of living is, what you like to do, all that
Yeah.
kind of stuff, right? So it's basic financial common sense.
Yeah.
That's it.
Yeah.
Actually,
So,
yeah, I don't want to go into deep. Let's just say have some common sense. Don't buy a bunch of shit you don't need.
yeah.
Um, yeah, live the life that makes you happy. If you like nice dinners, go have a nice dinner, but don't buy a Ferrari
Yeah,
if you
like
don't need
I'm
one.
not a guy like it's funny, we were just having this conversation. My fence was just being rebuilt and the contractor and I were talking about it. We were just talking about people that, man, they bought crypto and they've made $1 million on it and they went and bought 5 Porsches and stuff like that. Right? It's like,
Yeah, yeah,
I'm not
yeah,
that kind of guy. You know what? You've seen my numbers. Like basically last month I generated $51,000 or $53,000 in income. I could have
yeah,
taken it all out and cashed it. Of course, I would have been taxed to death on taking it out, which is one reason I don't do it. But
yeah.
even if I was taxed, I still live a modest life. I didn't buy a brand new car. My car is still a 2013 Nissan, those kind of
Uh-huh.
things. But what I have noticed because of this extra income now, because honestly, before I had this strategy, I was going to the bank, doing managed portfolio, putting it into what the bank said you should use our mutual funds and generating a whopping 7% ROI on this thing. And it's like at the time before this, I was saying, hey, you know what? If we just do it just the right way and move our hand in a certain way, I'll have enough money to live off of until I turn 90 years old. I need
Yeah,
5,000. It's generating 6. I'm happy. What's changed in my lifestyle now is I'm still only needing now, instead of 5 or 6, I can now actually say, hey, I can enjoy $10,000 a month,
uh-huh.
but my portfolio is generating 30, 40, 50,000. So I basically am still living that moderate life, but I'm actually using the proceeds to help my daughters build their portfolios up, to
Oh
do the
yeah,
things we wanted to do. But I still keep it modest. I don't turn around and spend it all. I basically, about a quarter I take out or 30% I take out. The rest I fully reinvest. And you can see, if I guess you can't see, but my portfolio has grown in book NAV and and current NAV. From, I think I started at inception, my current NAV was 1.25 million. I'm currently at 1.6 million. Again, as a growth investor, you're like, well, that's not that great. Again, I don't care what my NAV. If I 10 years from now was still at 1.6 million, I'd be happy, because
yeah,
it's
yeah,
not
yeah.
about
That's
growth. It's about my income is going up, because every time I reinvest, I'm actually adding more of these income generating cover call ETFs. So I honestly don't care that my current NAV stays at 1.5 million. If it goes up, that's a bonus. It's not something I'm striving for. I'm just trying to hold its own. So
I like that ratio you gave. You gave a 70-30 ratio, so 70% reinvested, 30% withdrawn. If you're working from if you're working from registered accounts,
yeah,
I work from a non-registered account.
you'd be taxed
I'm
right away. So yeah,
I'm accounting for so much tax.
yeah,
So I'm overcompensating. I mentioned this in a previous video that hasn't been released yet. I sort of divvy up a lot of my HHIS position is in my wife's account,
yeah,
non-reg, and not for no other reason other than just separating it. So hers just accumulates the dividend. I mean, the payouts every month,
right,
and at the end of the year, it will be used to pay off the taxes
right.
on
Okay.
the whole thing, and then
Yeah,
whatever's left over. It's a really blunt way of doing it,
yeah.
but it's just sort of making sure we have that. And then I might still owe more in taxes, but we have that more than covered. I
Well,
just want to make sure there's some pool there of
I
just purely
sure
for tax.
And I'm sure you already know that, but I'm sure hope that both your TFSAs are maxed to the nth degree.
Everything's maxed out.
Okay.
Yeah,
Yeah.
but everything I have is maxed out with
Okay.
my TFSA, my RRC, both of ours. Everything
Yeah.
is maxed out, but it's all growth investing and value
Oh,
investing.
okay. So here's a
That's
neat
why
thing, Gary. This is I think one of the best jewels of the cover call of the income-based strategy. My TFSAs are maxed out, of course. And I say TFSAs because my wife and I fill both of ours up. They're both maxed out with cover call ETFs. They're both they generate a combined $10,000 a month in income. What is the benefit of that? That's $10,000 a month of tax-free income. I can take that entire $10,000 out, no tax, and literally live off that $10,000. And the nice part about it is next year that money comes back as headroom, which I can then use my RIF income to actually refill it. Of course, the RIF income will be taxed to do it, but I've now got tax-free money that's just hitting me. There's no 30% on that. I mean, it is the biggest gift the Canadian government's ever given taxpayers if they use it properly.
I feel like the Canadian government with a TFSA
Yeah,
teed up everybody to become millionaires.
they did.
I feel like it's like, hey, I don't know, but I don't know why it didn't get explained properly.
Yeah.
But I think it's 18. You can open it. It's like, hey, but when you're 18, I can guarantee you're a millionaire by the time you're 40.
Well, and the biggest problem they did with that, Gary, they named it wrong. They called it a tax-free savings account.
That's what it was.
It should have been called a tax-free investment account. So people can actually look at it and say, no, don't use this to save money. That provides no value. Use it to invest, right? That was the biggest mistake they did, was its name.
How old are your kids? My kids are my daughter's 3.5, my son's 2.
My two are adults. They're 30 and 31. And it's funny you're doing so. One of the gifts, of course, you as a parent would know is to make sure that your kids, when they become adults, and a legacy you leave behind is to make sure that they're financially independent, so that losing a job or whatever is going to never hurt them, that they actually have money to do what they want to do. And so then one of the values of my portfolio generating so much is I live a modest life, but I'm using a lot of my my income generation to actually create income generating TFSA accounts for them. And I basically now, both their TFSAs have gone up to my youngest, which is actually in Blossom now. She's in Blossom because she's now motivated by fire. I won't say she doesn't like her job, but I mean, she would rather not work, let's just say, because of the modest income. She is now motivated that she could say, if I could build up my TFSA to the point that it basically replaces my salary, I'd be very happy. So I've got hers already up to about 40,000, and I've got my oldest down up to about 25,000. And I'll tell you right now, because you'll have a lot of the old traditional growth advisors and consultants saying, no. Young people should never invest in income portfolios. They should be focused on growth for the future. Like, that was okay in the day when an income portfolio only had income investments like bonds and GICs, when you could only generate 4 or 5% yield. But when you've got cover call ETFs now that are rivaling growth in total return, why are you not looking as a 25, 30-year-old to pay your bills? Like, you ask my daughters, they make $1,000 a month. I'm telling you right now, a lot of times, a lot of that's gone because they pay their phone bill, they pay from utilities. So they love this. So
I've always told, I'm sort of coming on board with the young people doing it as of maybe 10 minutes before we jumped on the podcast. And I'll tell you why. Because every time I'm a young person, I go growth investing. That's how I started, right? And that's how I built all my wealth. Well, I go start with ETFs. And if you get good enough, start becoming a value investor like me. That's where you really make a lot of money. But then right before we jumped on, I have this thing called the GG Wealth Academy. You can join it at GaryGillX.com. It's for free. It's just a community of all of us sharing insights and all this kind of stuff, right? It's all free. Everything I do is free. But there is a member in there. He's actually the moderator of our thing too as well. His name is JJ. He's at JJ Pandy on Blossom as well. And we have an area called Share Your Portfolio. He shared his portfolio this morning. He's only 23 years old. And it's $600-something thousand.
I think I know who you're talking about too.
All covered calls. And by the way, verified. He's verified on Blossom. He's a real deal. By the way, this kid knows so much about taxes. I was like, I did all his tax content. I was like, why didn't I just not talk to him? He should have been making it, not me. Right?
Is he the one from Montreal?
He might be. He's definitely not from Vancouver. I haven't talked to him from where he's from, but
Oh,
he
okay.
could be. Yeah, because
There's
he
a
asked me if
couple
I was going
people
to.
like that, Gary. And again, you nailed it. I mean, you
Yeah,
look at how many examples of people that when you got again, I don't want to pick because growth investors, I don't hate them at all. Again, it is a strategy. It's a very effective strategy, and people that need to do it. For example, if you have no need for income, like literally, like, look, I don't need income. My salary pays my bills. Then maybe a growth strategy is by far a better approach because when you're talking about growth of a NAV or growth of a portfolio, a growth strategy generally will grow better because you'll always see, yeah, covered calls always underperform their underlying. Absolutely true. Why? Because they're capitalizing income. So I don't have anything against growth investors, but what really is starting to make those traditionalists that basically are pure in their thinking is the fact that you've got people like 25-year-olds and 27-year-olds that are using these income derivative type investments that cover calls, and they're living off it already. Like, I mean, you already had Adriano on your interview. I mean, he's 40 years old and he's living in Panama. Like, I mean, this is not a 50, 60-year-old. Like, so,
difference though. But here's a difference though, and this
yeah,
is why when I mentioned the 70-30 split,
yeah,
you use your money.
I do use it.
Adriano doesn't. Adriano, he has money coming in because he's hyper successful. He's very
Yeah,
good at what he does. So
yeah,
he actually just can live off of other money because he's not
right.
retired. He's actually, I think he's reinvesting 100%.
Oh,
So
okay,
it's
yeah,
always been, yeah. So it's always been kind of hard for me to figure out how much is that number of you
yeah,
reinvest, you spend. So
right,
that's why I kind of, when you said 70-30, I said 70-30. If you're in tax sheltered, that
right,
works because it's working for
yeah,
you, right?
yeah, yeah.
For me, it's like I have yet to find someone who's doing what I'm doing, which is like all non-reg, and then how does it work, right?
Yeah.
Like I'd be
And the
interested.
one
I'd
thing,
be
Gary,
interested in that.
it's funny, and I'm going to sort of poke at my channel because I just created I just did a recent video that I released on how to deal with NAV stability strategies. So if anyone comes to my
Yeah,
channel, watch it. Inside that video, I actually have a chart that I created on how much should you reinvest depending on where you are on the income spectrum. So there is
yeah,
an income portfolio spectrum from the very conservative, which is more so what Adrian is. Like I've seen his portfolio. His is more on the conservative side. He only invests in index ETFs. Again,
yeah,
nothing wrong with it. It's a very solid strategy. He doesn't worry about NAV erosion, so he won't get what's called NAV lag having. For a person like that, you actually only should be basically reinvesting 5 or 10%. Again, unless you're a non-reg, then you have to deal with taxes. But if you're let's just say you're in a regged account. Um,
yeah,
if you're under 20% yield on your portfolio, I would say you don't have to invest any more than 5% back. And the reason that's the case is because you have to deal with keeping up with inflation, right? You should always be at least reinvesting to have your NAV grow with inflation. As
yeah. That's
soon
what I
as you
figured.
exceed over 20%, my portfolio, that video that I show you, as you go higher, you basically should be my formula, and it doesn't make me that I'm like Warren Buffett here, but my formula is 5% plus 1.5 times any percentage over 20. So if you're, say, running at a portfolio like mine, which is basically running at a 40% yield,
Yeah,
you do 5 plus 20 times 1.5. So I should be reinvesting around 35 to 40% of my portfolio. And again, it's just a rough number so people can understand because everyone says, well, how much should I reinvest? Well, you can't just say that because it all depends on what your portfolio looks like. If you're a conservative income investor, then how much you reinvest is almost negligible. If you're an ultra yield income investor, then you have to actually reinvest a lot because you have to deal with NAV lag, NAV erosion to counter that high yield that you're getting. So there are formulas, and you can use me, unlike Adrian, which, like you said, he reinvests it all because he doesn't use it. I live 100% on my investment income. Other than CPP, I don't get anything else. I have no pension. I cashed it all out and put it into this. Basically, my income comes from my portfolio.
yeah. That's good to know.
Yeah.
I had gosh darn it, I had something really good teed up in my brain, but I forgot. Maybe it'll come back. It'll come
I
back to me.
overtalked you.
No, you're just giving the nuggets. You're giving the gems. Oh, I knew what I wanted to do. I wanted to shout out your channel. That's what it was.
Okay.
In the comment and the description below, you'll see the Gary Gill I mentioned. You can join my academy, the free academy. But you'll also see Perry, and you can join the PIIverse.
A pie.
You'll see it in the first pinned comment. You'll see it in the description.
Yeah.
And then you can just go right through there. You'll also, when you get to his channel, you'll see all the content we're talking about. You'll see everything. You can also link through to his Blossom portfolio. So everything's there. Just click on that link, and you can.
Thank you very much.
Make sure you subscribe to the channel, especially if you're a covered call person. And if you're a hater, subscribe too. Every subscriber is what it all works.
It's so funny, Gary, because I know we're all content creators on YouTube. I sort of laugh at the trolls that come on and poke at you, because I turn around and say, well, thank you very much for making my YouTube channel more popular, because there's more comments. That means YouTube's algorithm loves you. So I actually want to thank you for all your trolls, because you're actually helping me. So
I come from advertising. So when you downvote something and just comment in general, the algorithm looked at it as engagement. And so, I did like this one video where, cause like I'm on this health journey thing where I'm trying to get back in shape. So like I posted a video of like, look how fat I am. Basically, literally it's called I'm obese. And downvote. But then people being like, one person like, you're out of shape, but it just helped the video. I'm on a finance channel. I should have got 3 views, but it cracked like over 1,000, which is not bad for like something completely unrelated. And because of that, I always get views just from hate. So let's move on to the next one. We have okay, now here's another big one. We're still on harvest, guys. We have MSTE.
Right.
That's the volatile one. That's the one that's been dipping a lot as of filming this. I kind of didn't even care that it was crypto. I was like, what do you expect? It's up a little bit today. We're filming this on the 10th. Right? Yeah. So it's up a bit today. I bought in at, I'll tell you how much I bought in at. I bought at my average share price. I was buying down. It's $13.79.
Oh, you got 40. Me beat. I bought it a little higher. I bought at $15.63. So it's down for me. Yeah.
Yeah. And I have $40,000 roughly in this position too.
You got, that's funny. I got 42. So but you got it at a better price.
Yeah, and I was thinking of like, hey, should I continue buying down, especially when it hit like that $12 mark? But I kind of was like, this isn't growth investing. I have to keep reminding, because growth investing, when I have a conviction stock, I'll just buy all the way down. If I'm like, I know it's going to come back up. But for me, it was more about, hey, this is already taken up enough, because I have a smaller portfolio. I'm like, this is already taking up 40% of my portfolio. I think that's enough.
And you actually brought up a good point, because this is actually and again, growth portfolios should do the same thing. So I'm not saying this is something exclusive to income portfolios. I believe I'm very regimented and very methodical. It's part of my IT background that when I do things, I have to almost engineer it to death. The one thing with my portfolio, every time I introduce a new ETF or a new holding, I actually add it into my total portfolio weight, target weight. And I basically say, okay, if I'm adding, like I'll use, for example, I just recently added COIW. We'll get to that later. It's brand new. So I turn around and I'll look, okay, it's new, it's risky, I don't understand it. Let me give it at 1%. So I will give it a target weight of 1%. And of course, then you have to jiggery pokery everything, because if that's one, somebody has to give something up. So the reason I'm bringing that up, Gary, is because you said a good number there. Like, I look at my MSTE, which I actually have a target weight of it right now at, sorry, I'm just going to point it out here. So my MSTE right now, MSTE has a target weight of 3.5%. The only reason I would buy MSTE is, one, if it's a good deal, which right now it is, and two, if I'm underweight. So right now I'm underweight just by a little bit. I'm currently at 2.9%. My target weight is at 3.5. This would be potentially a candidate that I would bump it up, but I would never dollar cost average it to death. I literally would stop at my target weight and say, yeah, you know what? He's generating the amount of income he wants now.
That's what happened.
And I don't care if it's at $12 or it's at 20. Like when it was screaming there, it was up in the 20 range for a while, or 18, 19 range. I didn't trim the gains, because if I trim the gains, I lose the income. So I basically just, it's nice that it's up high, but it doesn't matter to me. It's met my target weight for income. So
that's exactly that's exactly the same reasoning I had. An important note when people are listening to this. So for my portfolio, I only make my covered call public. And I've explained why in the past. It's just when I spoke with my wife, she's like, don't. And my wife's my teammate on this. We run our business together. She's like, please don't put all of our finances public.
Yeah.
Just because she's more traditional Indian than me, and she believes in something called nazar, which means you basically have bad luck for a like everyone will just start like hating on you, and you're like, so I was like, okay, I get it. And she's very traditional Indian, so I was like, I get it. I'm not gonna have problems with my.
And
wife.
I don't blame her for that, because even me makes me a little nervous. Sometimes I do this.
Yeah.
But again, sometimes
I for me, I actually didn't mind. I wanted to do it. I just don't want problems with my wife, and I respect her, and that's what she's comfortable with. So that's all it is.
Makes sense.
But then we sort of came on agreement. So I was like, can I at least do like the covered call portion, because this is exciting. I want to do case studies on it. I want to figure this out. She's like, yeah. Because it's like, I'm like, do 100K. It's not a big deal. We'll just like use that. She's like, okay. So I got her to agree. This is why it's public. So but for my non-CC, for a long time, I've been hearing people talk about like, hey, 10% your portfolio should be exposed to crypto, like 10%. I don't have any crypto in my portfolio at all. In my growth side, zero. I have nothing in growth, nothing. So the reason why I'm overweighted in MSTE in my covered call, because like I can go heavier in this because I have no exposure in crypto. That's why it's at 40% of my 100K, or else I would have only had 10K in it. I had it 10%.
Yeah.
Now I'm not going more, because I was like, now especially in the last few weeks, I've now completely separated the two portfolios where I don't even look at them the same anymore. I'm like, I have growth and stuff, own allocation, this. So now as I build this, I will never really add to my MST. I'm going to keep building all my other positions
to where it brings down
comes
your
10%. Yeah, just by adding up. Because right now, overall in my portfolio, MSTE is under 1% of my actual portfolio, whatever it is, like probably way lower. I don't know.
Right. So overall, overall in your finance, he's not a big risk. Right. So
zero risk. That's why there's a lot. So like risk tolerance wise, all that kind of stuff, it doesn't bother me. And the main thing was it hit the weight we were talking about. So and now we're just talking, I'm just focused on covered calls. I was like, I'm happy with this weight, but I feel like the weight is big, but instead of trimming, like you mentioned, you're not trimming, I'm just adding down to other positions. So I'll be using
it's target weight reallocation. Because whenever you start adding other ETFs or other covered call ETFs, there's no choice but the ones that you have will start coming down. They have to come down because the others are going up. So
another big difference between my strategy and yours is, and this is not because I have any disagree, I actually think you have the most efficient and the most, like, I like you're just siphoning out the most cash from this. Because I do value investing, growth investing, especially value investing, where I spend a lot of time researching individual stocks. I don't think I can manage your portfolio effectively. So I'll be going a little bit closer to Adriano's. Here's just like a handful of ETFs.
Yeah, he's got a very good, he puts the passive in passive investing, right?
Yes,
so I don't, like I was actually had a quick talk about it. He says, why did you call it PII? I said, in all honesty, it's the Kleenex of anything about covered call ETF income investing. So he sort of coined a generic term and almost made it,
Did he do that? Did he create that sort of name on YouTube?
Well, if you look on Wikipedia, passive income it's a generic statement, and he added investing to it. So
what a smart move on his, like, I don't know what he was thinking when he launched his
channel. He's become the Kleenex of that term. So
it's crazy because he launched it 5 years ago, and he's just like, I'm gonna a name associate with it. What a smart guy. He's a nice guy too. I really
the big difference between me and him now, and I was sort of hinting it to him. I said the P for me is different than you. I don't see it as passive income, because you could see on my portfolio running at 40% yield. It's far from passive. And again, I don't hate it. I love it. It's a passion of mine. I call it proactive income investing, because I'm actually, every month I generate so much additional excess income that I have to actively look at, where am I going to reinvest this? Like, whereas maybe a portfolio similar to his would just turn around and just drip it back, drip it back, drip it back. So he is really following the passive side of income investing. I'm actually following the proactive side of income investing, because I'm always having to actively do something to it every month and say, okay, where am I going to put this 25,000? Where am I going to put this 25,000? So the P is different, even though it's the same PII, but I'm proactive and he's more passive. And it's great. It's a beautiful strategy for him, because low risk, very little work. You fire and forget. It keeps generating income. And honestly, he could easily extract a good portion of that and live off of it.
He doesn't need to right now, right?
But anybody that has a strategy like him could easily do that and take part out. And even if it was only generating like an excess of, say, 10%, all you need is enough to pay for your inflation. So,
Yeah, that makes sense.
yeah,
So before we move on from MSTE,
yeah,
I think we both feel the same way about it. It's going to go up and down. I feel like there's a range for MSTE. I feel
yeah,
like for me, the low ball is like $11 or something, and it
yeah.
can go up as high as like, let's say 18 or something, like within that range. If it goes higher than 18, I'm like, I don't
That's
know.
its safe
If
box. Yeah,
Yeah, and it seems like a large spread,
it
but
is.
I feel like because it's crypto and all that stuff, I'm like, it is
Yeah.
what it is.
Well,
And I
yeah,
feel
and you
like
said it right. I mean, you got to look at each ETF individually. Like if you look at someone like HDIV, the
that'd
price
be
box
crazy.
on it is basically like $2. If it goes
Yeah,
$2
yeah,
in any direction, you're like, oh, what's happening to it?
yeah.
Someone
That'd be
like the
crazy.
ultra yielders like MSTE or PLTE, these guys swing $10 at a time. You just got to turn around and say, again, their price box is just bigger. Now, what you're looking for your viewers, what you're looking for between a price box and erosion is it constantly only going in one direction, which is down, right?
Yeah.
If it's only going down, and if you look at the 1 or 2 year cycle of MSTE or whatever, MST is too new for that, but look at something like MSTY, if it's always heading basically like this all the way down, you've got an erosion factor. Now, I won't call it a problem. It's a factor. You can counter that with reinvesting. But if you've got something that's basically sitting between a very wide price box, who cares if it goes to 11? At the end of the day, I know sooner or later crypto will go back and it'll start figuring itself out again. At the end of the day, its purpose in life is to generate income, and you just want to make sure it stays within that price box, right?
Now, and I'll say on MSC like where you can leverage that
Yeah.
price range, that price box. Now that I'm not in a rush to build, because I was kind of in a rush to allocate the 100K. Now I'm slowing down and be like, I have to do this properly now because I just
Yeah.
want to get it all allocated. I have certain positions I want to build now, and I'm finding that range within all of them. I'm like, okay, where is this kind of high? Where is this low with whatever data I'm working off of? And now I'm just gonna be like, all right, great. I'll just use that low as my buy-in
As a
time.
buy-in point. Yeah. You
That's
now
it.
know. And actually,
Yeah,
you brought up a very important factor with regards to income investing. And again, and growth investing likely has the same mantra. But at the end of the day, you really got to learn the personality of every ETF in your portfolio.
personality.
And I actually call it my catalog. I call it the PIIverse catalog. If something joins my portfolio, it's almost like I'm welcoming them into the family. You're going to be part of my family. Like I might boot you out after a 6-month trial because it's not what you're not playing nice. But at the
Yeah,
end of the day,
you're
once
violent and you hurt all the
you're
other.
violent, you're hurting all the other kids, you're out. So, but
Yeah.
if you join my PIIverse catalog, you basically are joining my family. And I will keep you for a long period of time. And the reason I do it is because I want to learn their personality. I understand when Coney is going down 60%. I understand when HDIV it drops to about $15. I like, no, I've had it for 2 years. I know how it operates. Yeah, it's a little on the low, but it'll come back up. So you actually hit the nail on the head as a key part of a successful portfolio. You got to learn the personality of every one of your ETFs because it'll let you sleep better at night. So
I love how you said personality because I never looked at my single stocks, my value picks as personalities or even my
yeah,
ETFs. Like no one looks at VOO or VFV as a
no,
personality. Like it's this bland, it's just like
yeah,
amorphous thing that just appreciates at average
yeah,
10%. And same with
yeah,
single stocks. Like I own maybe Meta has a bit of a personality. Like, no, but even then, like I just see it as like numbers,
yeah,
right? But with this, and maybe because it's the nature of these things, they go up and down.
yeah,
There's income being extracted every month. You now that you say it, I'm like, I have attributed traits
yep,
and traits mean
yeah,
personality. I'm like, that is interesting.
yeah.
I
You
only until you
actually,
vocalize it, I realized I was
yeah,
doing that.
and
Yeah.
that's the thing. A lot of people are doing it already without even knowing that they're doing
Yeah.
it. But at the end of the day, you'll notice that you've assigned a personality to these ETFs because you'll look at one ETF and say, "Oh, it's down 50 cents. What the heck?" And then you'll look
Yep.
at another one and say, "Oh, it's only down 50 cents." So you
Yep.
literally have attributed a personality to everyone because you know how each one operates. You know when you should and shouldn't be up at night on these because you know this is not normal for this guy. What's going on? Or this one is
Uh-huh.
normal. He's just within his personality, right? So
And you're dead right. It helps you sleep at night because
Sure
when
does.
MSTE started dropping and you go on Blossom, everyone's like, you guys are all
Yeah.
idiots. Told you this sucks.
Yeah.
I didn't even care.
Yeah.
My only conversation I was having was, okay, should I keep buying down like we mentioned, or do I think I've hit my target
Right.
allocation? I was having a completely different conversation that was in
You
myself
were,
with myself than
because
what
you
than online.
understood MSTE, right? So,
Yeah, yeah,
and so
yeah,
and it's funny because I get a lot of the traditional growth investors, and again, it's a small microcosm of the total group, but they'll turn around and say, "Oh yeah, well, what's going to happen when the markets crash?" And I'm going to say, you know what? I know my catalog of ETFs so well that basically, if we have a bad market crash where it actually is going to go down, I'm income shopping. I'll be looking for deals because I'll say, wow, holy crow, blocks is now at $18. I know it generally trades at around 20 to 21.
yeah,
And I know the markets will come back up. So I'm buying these while they're on sale
yeah.
because now, because you know the personality, you now can run a much more efficient portfolio because you now know when something really is a deal. And it's like, why am I not missing it? Why am I missing out on this opportunity? Right.
Yeah, yeah, I'm that way with growth right now. I'm right now with value picks. Like I just see it from a mile away.
Yeah.
I feel like I'm getting there now with this. I'm still a
With,
newbie in this. Like I haven't
yeah.
aggressive. I started in New Year's. I didn't start aggressively doing this on these ones
Yeah.
until summertime. But
Yeah.
I'm throwing. I feel like a good chunk of money at this where I'm learning pretty fast, and I make
Yeah.
videos, so I get a lot of feedback really
Yeah.
really fast. So I'm
Yeah. I'm learning.
iterating
That's
and
funny you said that, Gary, because I've only had my YouTube channel now 9 weeks. I think it's only 9 weeks. I started
yeah,
July 16th. Um, I'm learning a lot from all my dialogue and interaction from the comments
yeah,
on my videos as much as I'm learning from Blossom. So I actually find it really valued because they actually bring different introspectives on certain ideas. Like, never thought about that because I always am a visionary type of person, like a visual person. And when I turn around and told you this, when I said that each ETF has a personality, I need to personify my portfolio. If I can't turn it into a visual, then it's hard for me to feel comfortable about it. And that's, people will add elements to it. It's like, I never thought about it that way. That's great. I'm going to sort of absorb that as part of my understanding of my ETFs and my portfolio and my strategy, all of those things, right? So,
yeah.
yeah.
All right, let's keep this train moving. We're still on harvest, guys. Sorry, go ahead.
Yeah. So what we can do to speed up the boat with harvest, because I know we could go through each one of them, but you mentioned MSTE. So let me just give you a synopsis of how this works for me. You see on my list, I've got HHIS, which is the all-in-one for all of Harvest's American single stock cover call ETFs. The reason I have an all-in-one and I also have a few picks from the all-in-one is
Okay.
because I generally would rather, I don't want to pick the ugly duckling or the weakling in the all-in-one. The all-in-one has the entire, I think it's 15 now. I don't know what the exact number of single stocks. Of that 15, you generally get the center, and that's why you get 25% yield. I do it because it adds diversity and actually some core position protection on saying, you know what, I'm happy with 25, even though I got some ugly ducklings, but I got some rock stars in it. But what I do is I keep HHIS as the sort of like the diversified core position. And then I handpick 2 or 3 from the family and say, these are the ones that can generate me more yield than the average 25%. So that's why I did MSTE, CYNE, and PLTE. So all 3 of them are just income juicers from a very safe company and from a Canadian company. So that's why I
Which
picked all
one?
3.
So I know what PLT is. I know what MST is. Obviously. Which one's CNYE? Which
CNY is
company is it?
Coney. It's
Oh,
the
Coney. Okay,
coin.
that's what I
It's
figured.
Coinbase.
Yeah,
Yeah. Yeah, so
that's what I
those
figured.
3, and they're wild swingers. PLT is a rock star. It's all, I've actually had to trim some of its gains because it gained so much. I think I bought it at, where is it at? I bought it at I bought it at, my average is 1760 right now. It's currently at 25.25. It was actually almost at 30. I actually trimmed some of it because when I do a trim, I don't trim just because I want to capitalize gains. This goes towards the thinking of a growth investor versus an income investor. An income covered call ETF that's basically has a huge NAV gain like PLTE is right now doesn't benefit me much at all. Like at the end of the day, it still pays about the same income. So basically I'm leaving money on the table, having PLTE running at a 20% or about an 80% NAV gain. I'm still getting the same yield. So, or not the same yield, I'm getting the same distributions. So if it gets too high, I want to trim those gains, use the proceeds from it, and then go and invest in another covered call ETF that my rule is has to be equal or higher than what I trimmed it away from, so that I can actually now generate more income from two sources instead of one that's over NAV'd. It's weird that you'd say that, right? Over NAV'd, but it's not generating me any more income, right?
Yeah, I've heard that strategy used. I haven't been put in that situation yet, but
Yeah.
that's like a solid strategy of when it's over nabbed,
Yeah.
trimming it, that's a better
Yeah.
way to put it, reallocating. And the main thing here is equal or more.
Or more yield. Yeah.
Or
If you go
yeah,
lower, you're wasting your time. You got to go find something that will improve your portfolio in yield, because one of my three primary goals of my portfolio is, one, maximize monthly distributions. And my second goal is to grow my monthly distribution annually every year. So in order to grow my portfolio, I can only do it by two ways. One, by reinvesting. The other one is by rebalancing smartly to actually increase to higher yields, right? So
you know who does that as well? Now I'm remembering where I got it from. I think Paul Santori
yeah,
was
Paul
one who
does
told
that
me.
too.
Yeah.
Yeah. Yeah.
His podcast, as of coming out, it's coming out tomorrow morning here
Yeah.
on the channel. People have seen this. It'll be like 2 weeks ago from when they see this one, but like, so they'll have already watched his.
Yeah.
But yeah, he does the same thing, and he's sort of, yeah, he's pretty in line with you. You guys do
Yeah,
a
he's
lot of
very
similar
much in
stuff.
line. Yeah,
Yeah, yeah.
he's younger than me, so he's still building his portfolio. Whereas I'm a retired old dog, and I went all
How old
in,
are you?
Garrett. I'm
How old
62
are
as of last week. I just had my birthday,
you? Yeah,
so
looking fresh, buddy. Like
yeah,
the shirt, like
yeah,
the haircut. Yeah, you're
yep,
looking good.
yeah. I'm trying to do it with haircuts, right? So
Yeah, it looks good. It
yeah,
looks good, man.
yeah,
You're way more put together than I am, man. I'm falling apart.
yeah.
So it's
So with me, I went all in. Like, whereas I know what Paul's strategy, he was, and again, very, very smart on him to do that. And I recommend anyone that's just getting into any form of investing, growth or income, it doesn't matter. If you're getting into something as a noob or as a new investor, never try to run by saying, I'm just going to take Perry's portfolio and duplicate it. You should
yeah.
walk, you should experiment, you should dabble in and take one step at a time, and always know that. With me, I went at a faster pace. So I actually didn't listen to my own instructions. I
Yeah.
went from nothing to everything all in 11 months. And that
Wow.
included, I actually commuted my pension, which that was a huge step for us, but I had to do a lot of thinking about that one to say, is that the right thing? Now, we did a lot of thinking, and it made sense for us to do it because it was a non-index pension, and it would have eventually eroded in over time anyways. So we did it, but I went all in, and therefore I'm further down the road because I sort of compressed my experimental stage. So
That's good. All right, now we're moving on to Evolve.
yeah,
I personally like Evolve. They're probably I personally like because they came on my radar because a bank
yeah,
and Utes. Now I know it's Utes, not UTES. I've been saying UTES forever, but it's
yeah.
Utes.
Utes.
Uh,
Everyone calls
yeah.
it Utes.
But I kind of went through a journey of I was looking for stability in my cover call because remember I want to buy and not sell now.
Yeah,
So I probably won't ever extract the same yield you have. I do
yeah,
have a benchmark of like, hey, can I get to 30%
yeah.
yield? That would be a
It's a
nice
very
benchmark.
reasonable one too. Yeah,
Yeah. But I kind of wanted to use bank and
yeah,
Utes as core positions that I can build into. And the main reason was I had an inkling and even talked to Paul about this. We're like, I think their management's really good.
they
Because you
are.
look at management, and I think their CEO is really smart. And then
Yeah,
I was like, I want to really talk to them.
yeah.
But I ended up just having like some private meetings with them recently to be
Oh,
like, what's
did you?
going on with
Okay.
you guys?
Yeah,
Yeah, because I was like, I'm like, what is going on with you guys? Like,
yeah,
because like I want to see like, are you the real deal?
yeah,
Or like, because like I feel like they're actually building really good products. They
yeah.
are.
They are.
There, so I was like, okay, perfect. I'm like, great. I'm gonna start building like my positions into this because this is all long term. I'm still a growth investor. I'm still here to hold it for 10, 20 years. I want to make sure that
Yeah.
even if it's in my non-reg, I'm using it in
You,
my non-reg
you
till the day I
honestly
die.
can't. And again, it's funny. You look at my portfolio. I have 30 cover call ETFs, right? And there are
Yeah.
some good. Like, I'm never scared to buy anything from Hamilton or Harvest. There's no problem there. But I'm going to tell you right now, Evolve is my sleeping giant, because again, you won't get great yields from them. They're in the 17 to 12%, depending on which cover call you have.
Yeah.
But my spreadsheet's really complex. I track
Yeah.
everything. The one thing I track is my average just monthly distribution. And I can look up and down the list, and I'll tell you, there is no other cover call ETFs from other managers that have as stable a monthly distribution as Evolve does.
Yeah.
It is boring for me to track the distributions of call and bank, because
Perfect.
I know it's the same number. It's for 2 years, it's been the same number. They never go up, they never go down. And for somebody that wants a really stable cover call ETF, again, I only hold bank and call. I don't hold UTs.
Yeah.
Call has been, I've actually had to trim it twice, because it not only has generated a very steady yield, but basically it's gained so much. I bought it at a good time. I bought it way down. Like my cost on call is 10.11, and it's at 13.62. So it went up almost to 16. I actually sold off at 16.
Explain call. What's call hold? I'm not familiar with that one. Which one's
call? Basically is a lot. I think it's Canadian, basically a Canadian mix of cover call of underlyings, whereas bank. I have to find out which call is. It's so boring. I actually don't even follow it anymore.
But basically it's a mix of writing cover calls on large Canadian companies.
Yeah, I think it is. I don't quote me on it, because I haven't even looked at call in so long. All I can tell you that if you actually look at my portfolio performance on a cover call ETF basis, again, not based on gross numbers, but by percentages of ROI, call is always on the top or near the top every time. And again, it's not a rock star with yield. I think it's, let me see here, call. I'm just trying to find it right now. Right now, my call is running at a current yield of 11%. So it's when you look at all the others, it's pretty boring. But when you look at its ROI, at least for me, again, because I bought in at the right time, it is a rock star on my return on investment. And I say bank is the same thing. It's currently yielding at 15%, and I basically got in at 7.18, and it's currently at 8.61. It's one of those two. Those are the two. If I literally put all my portfolio in those two, I wouldn't be getting much yield, but I would never worry. I could go on a 2-year vacation, come back, and not worry that something went wrong with them.
That's what I'm looking for, though. Like kind of like what you have, like a blend of stuff of conservative, solid ones. So I think in my portfolio, if I'm putting it in buckets, I'll be using Evolve as sort of foundational core position.
Yeah.
They're my safety net that I don't have to worry about.
Absolutely safety nets. No one's going to write home saying, "Oh my God, look how good call did on yield." It's boring. But when
and I don't have to worry about. And even for me, like when I'm doing YouTube, it's like I'm talking about what a lot of times, like here's what I'm doing, and I'm just a little bit more conservative that way.
Yeah.
I'm fine with it. So and I feel more confident. Like that's why I probably talk about them. I'm like, I like them. I feel confident in their management. I like their products. So I'll be building into banks and Utes. Those are the two kind of I've earmarked, but they got some new stuff coming out, like Big Y or something.
Yeah, Big E and Maple. And I'm actually interested.
Which are higher yield, right?
They're higher yielders, They're actually higher yielders. They're very much competitors. I think if I'm correct, they're sort of Evolve's version of HHIS and HHIC. If I understood that correctly.
Do you know when they're coming out? Because I want to make sure if the buying price looks decent and it's comparable, I'm gonna probably snag it.
I think it's really soon, because there's a lot of talk about them right now. So if there's a lot of talk about them, that means they must be ready to release, or if they haven't already released. So.
I think it'll be released by the time we release this video. So I'll probably add those to my portfolio as well and just see how they perform. All right, so that's Evolve. We all like them. And they're foundational ETFs.
Oh, so I just wanted just for your audience, call is Evolve is U.S. banks. So they focus on U.S. banks. They're American.
Oh, so you're with bank and banks. You're with bank Canada, bank U.S. Okay,
bank is Canadian, and it looks like call is the American version of it. So
So you're like, okay, my banking Evolve is going to handle that. That's great. And you have large positions. You have a large position in BANK.
Very big. It's actually one of my biggies.
Yeah. So that's a big one there.
Yeah, I should have told you that. Of my rock stars on positions, like generally, remember I told you, I don't like holding anything greater than 5%. Bank is one that's over 5%. It's at 5.5%. And so he's one of them, and HHIS is over 5%. So bank is definitely one that I did it. I did that because when I consolidated HMax, because I made the big battle between HMax Bank and BKCL, I basically reluctantly let go of HMax because it was constantly showing a small distribution drop every month or two, whereas bank was not doing it. And for that reason, I reluctantly dropped the one ETF that brought me into this whole industry. So that's why bank is big.
I did a comparison video on HMax and bank.
Yeah.
And bank came out clear winner.
It did.
That's when I decided. That's when I was like, oh yeah, cool. I'll go with bank.
The other one that's also in that comparison is BKCL. So
BKCL, yeah. I do comparison videos whenever I make an investing decision of like, here's the two, and then before I even invest, then I leave it to the audience to like tell me what they think, and then
what do they think?
Take that. Yeah, and I go, okay, did I miss anything? Because I do miss stuff. Okay, that's Global X. You have ENCL, BKCL, USCL.
Yep.
USCL
is my other rock star.
Man, I've been hearing about ENCL. Who told me about that?
Yeah.
Somebody. Oh, gosh darn it. But ENCL, that's one I earmarked. It's on my watch list now. I haven't done any research yet.
Yeah, ENCL has been one of my long holders. It actually, if I looked at all my target weights, ENCL is the largest holding I have out of all my covered call ETFs. They run at 7.5. They're actually overweight for me. I have a target for 7, and they're running at 7.5. First of all, I love energy. I love the energy sector. That's why you see Athabasca at the very top. He's my rock star for pure oil stocks. And ENCL is my only energy sector covered call. So for that reason, I love energy sector because it's a good generator. It's very volatile. The other thing is it's my only holding. So I made it very big. I've already held it for almost 2 years. It's 2 years next month I've held it. So it's a good one.
You know who also has ENCL and who got me on with Paul again?
Yeah.
I think.
Oh yeah, I remember he likes it as well. Yeah. So
they're up, right? You were mentioning. So and I think the main reason why I don't think I've got it right now is I don't think the buy-in price is right for me.
Actually, their buy-in price, I know that little baby like the back of my hand. Remember, he's one of my children.
Yeah.
ENCL is basically on the low side right now. It's actually a buying price. I'm in at 1969. I would turn around and say that ENCL right now is at a pretty good price right now.
Is it below your buying price?
Oh, it is. I'm in at 1969 and it's currently at 1855. If you
I refuse to buy any stocks at higher prices than you paid. Okay,
honestly, they did have a dip back about 5.5 months ago that they dropped well down into 17 range. That's very unusual for them. But I was already at a 7.5% target weight. I couldn't buy any more of it because it was just as being non-responsible on that. So basically, I just sort of like, oh, geez, if anyone wanted to buy ENCL, that was the time. They've gone up since then, but they've been very stable. Right now, it's another one of those boring ETFs. Their price range has been from 17 to 21. They generally stay in the 18 to 19 range. You can't wait for them to go down. They rarely go up and down. They're boring when they go up and down. So again, another evolve or Oh, sorry, that's Global X. Sorry, that's another stable one.
What was their yield? You might have told me. My dog was barking at the quick.
Their yield is currently at 16.8%.
All right, cool. Yeah, okay, that's solid.
It's a nice one. I like those because when I talk about my core position in my portfolio, remember 50% core and the other was the goal. I'm looking for anything in the 10 to 20, 21% range. So ENCL is a darling for that. It's running at the higher end of that number. It's at 16.8. It's very stable. It did have a little bit of a distribution drop, but it actually, I think, came back up again. So they brought it back up again. So it's a darling stock. It's definitely one of my top holders. It's the top holder, actually.
Distribution drops aren't the end of the world. They make sense.
It
sometimes.
happens.
Like sometimes Yeah, and they're required sometimes in
Well,
order to
and you nailed
manage
it,
the
Gary.
fund properly.
There's at points that they do have to drop the yield,
Yeah,
and
but they brought it
again,
back up. Yeah,
I would rather they do that than erode the ETF. So if they need to go down,
yeah,
let it go down. I'd rather take the
yeah.
lower distribution than a NAV erosion, right? So
BKCL, that's banks.
yeah,
Again,
that's bank's
USCL is a
counterpart. Yeah,
USCL was something I was kind of building a position in. I got like
yeah,
$5,000 in it or something. I don't know what I have. It's not that whole lot. I have UCL. I bought it at $22.54. I have $4,531, and not a whole lot. I just bought into it right now.
yeah.
You have quite a like
I have
40,000 something dollars
1,800
in
in
it.
it. I've had it for over a year, 2 years. Like it's over
1,800.
2 years.
Yeah,
It's been one again, similar to like ENCL is one of my stable ones. I hold a good position in it. Why I like it, and it's very much I'm totally in alignment because I believe the same thing. I believe in leverage cover call ETFs. So if they have a leverage, I'll take it. That's why
yeah,
ENCL. I have ENCL because it's leveraged. So
leveraged.
my belief on it is if I already believe in the cover call ETF non-leveraged, then why not get the leverage version? Because you're just going to get another 2 or 3% more yield. So, and I think USCL is a leveraged one. And currently I hold 3% of USCL. So
Yeah, my reasoning was first. I think every cover call ETF I would get would be leveraged at this point, just from my
yeah,
experience. And
if it's
then
available, like you,
if it's
sometimes they
available,
don't
yeah,
have them. American cover calls don't have much leverage. They're just starting to get it. It seems like
yeah,
Canada always leads the US on anything financial institution based. They were the first to
yeah.
do ETFs. They were the first to do cover call ETFs. They were there before the US on leveraging inside cover call ETFs. So they are now, the Americans are starting to pick up on that. I think it's a great addition to any cover call ETF. So yeah.
And another thing for USCL was, for my rationale as a growth guy, it's the way Adriano put it was like USCL is cover call version of VFV.
Mhm.
HYLD is cover call version of VSP.
Right.
So
Yeah.
my brain kind of went, and I don't own VSP, but I own VFV.
Oh, do
So
you?
I don't
Okay.
own I don't own HYLD. So I was like, because I'm like, I don't own VSP, but I went straight to AUSCL because I was like, well, I own VFV. I
Yeah.
believe in that one. I checked it. If you reinvest dividends, they perform kind of the same,
Yeah.
right?
Yeah.
Except, I pay taxes on it, so it'll underperform even
Yeah.
more than what Adriano charted out. It's different for me. But still, I was like, okay, cool. I like that comparison. So I got it a lot, mainly because of that. I was
Yeah.
like, great, I can use it as like my core S&P holding.
And it's
So
funny because I look at it, they literally is 6 to 1, half dozen. Yes, one is hedged, one is not hedged, one is,
yeah,
at the end of the day, and I know Adrian does focus on that, and that's great that he does. I look at it as HYLD is 12.3 yield and USCL is 12.8% yield, and they're both pretty
yeah,
much the same. I just hold
yeah,
them both. That way I'm protected.
yeah.
So
Yep, that works. So okay, so that's Global X. So for me, Global X is probably gonna get ENCL, most likely gonna get ENCL, because you said that's oil, right?
yeah, what's that?
Um,
ENCL's oil. Yeah, it's all Canadian
yeah,
oil sector, not American. It's all
which
Canadian
means,
oil sector.
and I don't have any exposure to that. So then I'll have just constructing this in real time while we're talking. So I got bank and Utes. Utes probably has a little bit of overlap between
It has
ENCL,
utilities and pipelines, so it does have a little bit of energy in it.
yeah,
Um,
but it's fine.
but the
Uh,
ENCL is focused on oil producers, a lot oil and
Producers.
gas producers. Yeah, they
Okay.
do have. I think they do have TC Energy and Enbridge. I'm not sure, but they definitely are more focused on the energy production. But they do
Yeah.
have the transport in it, I think.
Now we're going to move into some US ones.
Yeah.
We're going to talk about Roundhill. I got introduced to Roundhill through Eugen Vasquez. You know who Eugen Vasquez is?
I just learned about who he was last night because we had a major topic discussion last night when I released a video, and I realized, hey, we all make mistakes. I realized the new single pay ETFs from Roundhill. I really liked them. I love that they actually have some significant growth and they have some significant yields. And then I realized they're not cover call ETFs. So, and I did my video calling them cover call ETFs. So I actually had to pull my video out because I didn't want to deceive my audience and say, hey, these are great
Why
cover
did
call
Eugen tell you
ETFs.
that?
What's that?
Did Eugen tell you that?
No, one of the commenters in the post, he said, Barry, you do know that these aren't covered call. So I went on to Blossom, said, did you guys know that these aren't covered call? And somebody pointed out Eugen's video to say, what the heck are these leveraged swap agreements and stuff like that?
Man, I love
Yeah.
Eugen Vasquez. You got to watch his YouTube channel. So I interviewed him on the podcast.
Oh, did you?
He is a crazy US investor who is just doing weekly pays. He's a young, me and him are the same age, but he's just like,
Yeah.
I don't do his investing strategy, but he does this great market recap almost every week where I don't have the time to watch the news. But me and him are interested in the same companies.
Yeah.
We're very in line with like what we follow, even though he have different trading strategies. So I'll actually watch his videos to get market updates. I'm like, because he's paying attention to what I need to be paying attention to. He tells me everything in like 15 minutes. I'm great.
See, and that's what I need, having somebody, a resource like that. So I just learned, I watched this one video on why MSTW is different than all the other weekly pays that they actually hold cover call. But I could just tell from his video that, first of all, his strategy is a little different than mine. He's very aggressive, very like yield at all costs. Like I know he turned around and said, I don't want anything that caps me. And I was like, well, no, I don't care if I'm capped. I'd rather have more stability. So him and I are different there. But if he can actually do good market recaps, I would really be looking forward to that. So I might actually subscribe to him for that reason alone.
Dude, you have to. He is so good. Like he's just like dense information. Goddamn, he knows how to articulate it. And it's like, and if you're ready to learn his investing style, you'll just download that stuff like the Matrix.
I'm gonna have to maybe reach out to him because honestly, I'm just now that because I really do sort of like these week pays from Roundhill. But now that I learned that they're not covered calls, they're these leveraged swap agreements. Honestly, I've spent like 2 hours trying to understand how they work. And there was a couple of people from Blossom that actually started to explain. I said, give it to me in grade 6 math. I don't understand how these work. It'd be great if he turned around and did a video and say, here's how it works. This is how this works, right?
I'm going to send him this podcast. Be like, hey man, people are requesting this now. And by the way, he is just one of the nicest, most humble guys, super hardworking, and he's got a hell of a story. Check out the podcast, guys. If you haven't seen it, you should check out the podcast. He just knowledge drops left, right, and center. So he's the one who got me on Roundhill. QDTE, I think he probably wants to do. RDTE.
Those are my two ones that I've had all along. Any of the other ones that you saw are brand new, like only a week old. Those are the two week pays.
Can you remind me, what's QDTE?
So QDTE is the NASDAQ weekly with weekly pay, 0 DTE. And RDT is the Russell 2000 weekly pay, 0 DTE.
So indexes.
They have, and this is where I actually created a YouTube video because I was doing a rebalancing on them. So currently I've had these two, and I can't talk about these two without sliding down to number 19 and 20, which are QQQY and IWMY from Defiant. They are bitter enemies. Like these two are literally, QDTE is QQQY and RDTE is IWMY, but one does it by cover call and one does it by puts. The news I just heard yesterday is it looks like QQQY and IWM that Defiant is doing a major perspectives change, and they're actually looks like they're moving away. I haven't read all the details. My understanding is they're moving away from puts and going back to calls like everybody else. But the reason I'm bringing it up for my portfolio, I believe I'm a little bit overweight because I've got both a Roundhill version and a Defiant version. And the video that I had to actually recall, I'm going to redo it again because I like giving my audience the background on how I think about rebalance, not just like I sold those and I bought these. I like saying, here was the thinking why I picked QDTE to pull back on and versus this, and here's what I think, so I'm going to redo that video once I decide where I'm going to actually put the proceeds, but I am actually going to be reducing my QDTE and RTT positions. They're very large right now. They're 1,900 and 1,800.
Yeah.
Let me just tell you where they sit. Sorry.
He's saying, and by the way, when he says 1,900, he means shares.
Sorry. I'm currently 6.5 and 6% weight on these. First of all, they're over my fives. That's another reason why I decided to bring them down. And secondly, they have too much competition with Defiant. So I would rather have Defiant at 3 and and the Roundhill's at 3. So I'm going to likely trim down my QDT and my RDD down to a number, use the proceeds there to buy. I was going to buy all the new week pays, but now I'm rethinking if I'm going to, I still might, but I haven't decided, but I will be using the proceeds to expand my weekly pays because I really like weekly cover call ETFs. I'm starting to like them more and more.
What account do you hold the weekly pays in?
I hold everything in my RIFs and my TFSAs. Like I don't distinguish between the two. I fill them all up equally. I don't have them in my non-reg.
Are there any tax? Do you know if there are any tax implications of holding weekly pay U.S. companies and even holding those U.S. companies in your TFSA? Is there anything negative? Like, I know there's a 15% withholding.
15% withholding tax. Yeah.
But that's such a small portion of everything that's being paid out, right? It's like,
well, and that's what people, I find in the Blossom community, a lot of times people are like, oh yeah, but I'm going to be hit with a 15% withholding tax. It's like,
dividends,
okay, you're getting 50% yield. What's 15% of that? It's like, there's no Canadian cover call ETF that will give you anything close to that number. So to avoid 15%, just so that you don't have to do it, you're literally giving up a 50 or 40% yielder because of 15%. Well, the alternative to that is to put it into your RRSPs or your RIFs. Well, if you put it in there where you're not being hit with a 15% withholding tax, when you eventually have to take that money out, you will be hit with a 30% income tax hit. So I don't worry about if a U.S. ETF is sitting in TFSA or RIF. At the end of the day, it's pay me now or pay me a lot later. So I put them in both. And I do like the weeklies. You can see a lot of my, you won't actually see this here, Gary. I know the audience doesn't see what you're looking at, but in that chart from QDTE all the way down to ULTY, they are all weekly pairs.
Yep.
They are all weekly pairs. And that list is getting bigger. I actually am liking the weekly pays. I'm starting to get used to it. At first, when they introduced, I'm like, come on, who needs weekly pays? At the end of the day, if you can't budget over a month, what's wrong with you? But I'm actually starting to like the weekly pays. My Fridays are actually enjoyable because I call them payday Fridays now because a lot of them pay on Fridays. But now there's some on Tuesdays and there's some on Wednesdays. So it's nice actually seeing that trickle effect of money coming in every week. And that's why I'm actually starting to gravitate a little bit more towards my weeklies. So
the reason why I was kind of into, at least let's say, like S-Day, Q-Day, and all those ones, right? They're bi-weekly or not bio. I don't know what the word is.
Those are bi-weekly.
Twice a month. I'll say twice a month because the way I phrase it, people get mad at me. Twice a month. And then the weekly pays is because I didn't like the idea that there's a countdown to the monthly pay ones. Like everyone's like, it's coming. I'm like, this feels weird. I don't like the fact that there's a countdown to when money's coming. I'm like, I want to come frequent enough where it's just like a normal thing in my life. Not like, not just like, oh, yeah. So like, it was more for like that psychological reason. I didn't like that there was a countdown to like money.
Well, it's funny. All the Canadian ones, again, they're now starting to realize that the income investor likes weeklies. And they're starting to, even they're having troubles doing it because it is a high administration cost. So I'm sure they're trying
That's what it is, right?
Yeah, they're trying to keep the administration costs low because I know they can do it. It's just they don't know how to do it yet. But at the end of the day, again, there's people like me that are actually starting to gravitate to the more frequent cycle paydays because, again, I don't need it, but it's just nice to know that you've got that more granular investment plan, because then I could maybe reinvest some of it in quicker cycles, which means you can compound faster, right? So
let's finish off Roundhill. You have HOOW and COIW. That COIW is probably like coin.
Yeah. So both of these are these new. We were talking about week pays from Roundhill. I've warned the audience what I learned my lesson of. These are not cover call ETFs. These are very volatile, leveraged, what are they called? Swap agreement type ETFs. So it even warns you in the perspective, if you're getting into this, it's not for the faint of heart. You got to be ready for very wild swings. They're open-ended on the rises, but it would also be on the downs because they're leveraged. But I'm still not scared of them. I just want to understand them. I've dipped my toe in it with HOOW and COIW, which is Robinhood and coin based underlyings. First base, I just bought HOOW last week, and I'm already up 28% in 1 week because of course, not only because of them, because Robinhood went onto the
S&P 500.
S&P 500, and that literally
Yeah.
shot it up. And of course, if anything shoots up a stock, these will actually magnify because it's 1.2 times. So they actually went up higher. I went up $10 on Monday.
Oh,
$10 a stock. I bought it at 59. It's at 72 today.
Yeah, that's nice.
I know.
That's
So
nice.
like I'm turning around, it's like, should I just sell it off and just take the gain? But at the end of the day, I want
it's gonna
right.
It's gonna correct at some point.
Oh, it will. It could dive as fast as it can go up. So I'm not gonna celebrate. So.
Okay, so that's Roundhill. This one here, I've never even heard this company, NichoCrypto blocks.
Yeah, it's getting. Yeah, it is a unique little baby that's a new company apparently that's doing this, or relatively new. I only learned about it because Marcos, I don't know if you know Marcos, has.
He was one of my first guests. He was like guest number 2 on my podcast.
Is he? Okay.
I've known him for a while, actually.
Okay, good.
A while now, yeah.
If anyone wants to know more about it, I actually was interested enough after he did an interview with, I don't know, one of the top guys from this NichoCrypto, whatever. They introduced blocks. It is a unique type of environment. They seem to be covered call ETFs that are focused on growth. So I like that because a lot of these higher yielders, like this one's, I think 35% yield, if I remember correctly. So it's not like a screamer. Where is he? He's right now at 41% yield. So he's not a screamer, but he's definitely up there. But the reason I was intrigued after watching that video from Marcos with that guy, and it was a good one. He explains that they're taking a different approach on how they're doing the structure of blocks. And I sort of liked it enough that I said, you know what, I'm interested enough that I want to have a position in it, because it'd be nice to have a real stable NAV'd yielder at 35 to 40%. So that's why I took an experiment with him. He's still relatively new. We'll see how he goes, and if what they say is actually true. So I call this one a toe dipper right now. And I'll see in a year from now if it's something I'll still hold.
Nice. So that's blocks. That's NichoCrypto. I can hear my daughter here. I'm slightly distracted. She just opened my office door.
Oh,
she's looking at me.
She can join the conversation.
I'll see if she meanders off. I saw when you're talking, I got distracted. I saw a little arm poke through. I was like, oh, okay. Because now that's like 9:45. They're being pretty active now.
Yeah.
All right. So let's go to Defiant. You have QQY. We talked about that.
Yes.
But we can kind of summarize it again really quickly. You have IWMY.
Yeah.
USOY. And very quickly, you did mention Marco Milas. He has a YouTube channel. Check it out. He also has something called the ETF Academy. Yeah. This guy interviews like everybody in the U.S. He's a U.S. ETF guy.
Yes.
So I feel like if you're interested in ETFs in the U.S., he would be the number one resource.
He's a good guy
in my
to follow,
opinion.
yeah, because he focuses a lot on U.S. Yeah.
Once again, one of the nicest guys I know. Yeah. Young, humble, kind. This guy's just doing it. I love the guy. He's fantastic. So check out his YouTube channel. Follow him everywhere. Join his academy. That guy's good stuff. Okay, so we have.
Yeah, so on my Defiant, I can just summarize this one. I already said that QQQY and IWMY is the NASDAQ and the Russell 2000. If anyone wants to know a little bit about the history, these guys were the rock stars when they came out. I've held them for 2 years as well. They were the rock stars because IWMY had yields of 125%. They were crazy yields. The problem with that was they were doing unsustainable yields, and they were quickly eroding. Like if you look at it, I think I'm down about 60 or 50% on them. They went down enough that they actually had the 3 times reverse split. So when you look at my number of units, you could see that it's at 951 and 982 units. That's because that divided by 3 made that. So these are actually have already reverse split. That sounds bad. The good news is that Defiance, I think, I'm just speaking on my own behalf. The owners or the leaders at Defiant, I think, had realized that, you know what, people don't want yield at all costs. They want to see some stability. They don't want to see people eroding in order to get yield. So sometime early last year or early this year, they actually started changing their perspectives. They put in target weights or target yields of like 30% or something like that. You can see it because their price box has now stabilized. They are really like, whereas it was always going down. In 2025, it literally has stabilized. They are now actually even going up a little bit there. So I would call them and Roundhill are now sort of equals in the sense that they're both doing this at the same time. Their
They
yield is a
course
little bit
corrected,
better than Roundhill, but they're sort of like 6 of one, half a dozen the other.
but they did a major course correction, is what you're saying. Because I
Major
heard that.
course correct. And they're doing another one, as I just told you about earlier. They're also looking at actually moving away from what I understand. Don't correct me if I'm wrong. They're moving away from, I just got it in the mail actually, that they're looking at another perspective change of moving away from puts and moving to calls, which is another major shift in their perspectives if that's what they're doing.
Yeah, I missed all that sort of, I guess would be, I don't know if you want to say drama or just the stuff that happened with Defiance earlier on. They didn't come on my radar until I met Ari Gutman. He was the
Yeah, I
one,
know Ari. Yep.
yeah, so like he sort of like through him, I kind of figured out what Defiance was. And
Yeah.
then now through interviewing you and Paul is when I kind of learned about what happened earlier with
They're
their
down
funds. But
55, 57% for me. So my NAV is eroded. But the good part, again, I don't, the only thing I care about it is that it would stop doing it. And it did stop doing it.
it did
I'm
stop.
now stuck at around 55% unrealized loss, but they deliver on distributions. They both have positive ROI. Every month they pay me money. And as long as they keep doing that, and I'm very excited about them maybe making this extra prospectus change, because if that actually helps even stabilize it more, that's great. So I don't see me really getting out of these two. They're running at a 3% target weight, and I'll likely hold them that way because they're my exposure to the NASDAQ and the Russell. So now the last one on there, I might as well talk while I'm in here, is USOI. USOI is the poster child of erosion. So I hold a large position in it. Remember I said I had no oil? Well, I lied. USOI is the American version of the oil sector. So it follows USO, which is very much oil commodity based type of thing. The reason it's definitely an eroding ETF, and I actually, in one of my videos, actually show about NAV erosion. So anyone that goes to my channel and subscribes, there's one talking about NAV erosion. I use USOI and in its underlying USO as an example of what erosion looks like. Now, that being said, it's a head scratcher because at the end of the day, its erosion is terrible, but its yield is 88%. So,
what? Yeah, there you go.
Yeah, so it is going down slowly. Like, of course, as things erode, they also pull the distributions down. But the distributions are going down very slowly. And so I've sort of said I'm taking this one to the end. In other words, again, no cover call ETF for the most part will ever go to zero, because that's one of the other myths people say. They'll all erode to zero eventually. First of all, they can't, not unless the underlying basically delisted.
Goes zero.
It goes to zero. It really can't go to zero, but it could erode and erode and erode so that it actually almost trickles down to a small stream. Right now, I'm just going to milk it to death. I already have a major investment in it. Why would I capitalize my losses and then walk away from that? I'll just keep it. It's making me $1,500 a month, so I'm not going to sneeze at that. I currently hold 1.3% yield of my target. So there's nothing there. It's like, hey, you know what? But if anyone wanted to see an example of an ETF that is eroding, USOI is an example of that one. So
I'm looking at your channel. Is it in the video? Which one? Do you have a couple here? Is it tackling NAV erosion head on, or is it mastering income and NAV growth with no compromise?
Yeah, it's that second one. Incoming which one? Sorry.
Mastering income and NAV growth with no compromise. That one?
Yeah, that's that one there.
All right, guys, check out that video. There you go. I just named it for them. They can find it on your channel.
Okay.
All right, let's move on to now. Here's a bunch here.
Yeah, it says the YieldMax
bucket. I'm going to name them all.
Yeah.
And then I'll just name them all first.
Okay.
LFGY, ULTY, that everyone hears
Everyone
about.
knows that
PLT,
one. Yep.
That's so much content on YouTube about that. PLTY, AMZY, MSTY, lots of content on that one. NVDY, HOOY, CONY. So the ones just by their, just walk through them.
Yeah, I'll walk through them because there's a lot here, but they're in categories. So I could talk about them by categories. So among them, the first two are LFGY and ULTY. They're both weekly pay, zero DTEs. I have them because they generate some good yield and they actually pay every Friday. So that's why I have them. I'm not as in love with ULTY as everyone else is, but I did want to have a position in it. So I think I have like a 1.5%. Let me just do it because everyone loves talking about ULTY.
It's your smallest YieldMax position.
It is it's only 2%. I only hold 2% of my portfolio in ULTY. I will not hold anymore. It also is showing I won't say troubling signs. It is really struggling to stabilize its NAV. Like, it has times where it looks like it's doing good, and that's actually why I bought into it, because it looked like they were going down. If you look at their price chart for the last year, it went down, 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 and somewhere around March, it's flattened, and it stayed flat. It's actually, so I said, hey, look, they've made changes. They've likely put secured puts behind, and did some call spreads, and they've started protecting the NAV a little bit. So I said, okay, good enough for me. I'm going to buy it now. So I bought the 1.3% into the holdings, and then it started dropping down again. So again, I'm not too worried about it because my holding weight's so small. I honestly, again, I'm just me, but I don't know why there's people out there that are putting 40, 50, 80% of their entire portfolio on ULTY. Honestly, I don't think that's wise investing, and it's just my opinion. This is definitely, it's called ULTY for a reason. They bought the most ultimate swinging, highest volatility tech stocks inside of that cover call ETF. And you got to expect what it is. I mean, it screams at you that it is very volatile. And if you're doing anything that volatile, you really got to decide if it should be part of your core position. It should be definitely something you can use as a juice enhancer, but I wouldn't put it as a core position personally. But everyone is their own investor. I can't recommend they do anything else.
I saw one guy in Blossom made a post. I forgot his name. And he's like, he invests 100% of his portfolio into ULTY. And he's like, you can say what you want. And I was like, I don't have any opinions about it, but I just messaged him and being like, are you serious? Did you actually do this? I'm like, if you did, can you tell me why? Like, maybe make a decent, I think that'd be a very and he seemed like kind of like an eccentric dude. Never responded back to me.
No.
So, but I just wanted to know, like, if he's serious, I'd like to talk to him.
There's gamblers out there that will literally go to the slots. I think at the end of the day,
that's what he was saying, actually. Yeah.
I wouldn't put at 100%. I would not follow a strategy, even with something like VU. I would not invest all of it in VU. At the end of the day, I believe in diversity, because something can happen to any investment. And if anyone says, no, that's not true, how many people lost all their retirement when they had Enron? I mean, you look at it, you can never say never on any investment going bad. So never invest in one investment.
One person I know, only one person through my investing that only has one investment and it'll never go back, is fairly, in my opinion, he's just an awesome guy too. I keep saying everyone's awesome, but because they are really nice people. I get to know all you guys.
You get to know the awesome
quite well. Yeah. But is Mo from Momentum Finance?
Yeah, I like Mo. He was one of my first. He was my first interviewee.
He owns one thing: XEQT.
Yeah.
So, and basically, guys, if you guys know, it's a world index fund. Essentially, it just tracks everything on the planet, and it's weighted equally by market share, more or less, from each country.
Yeah.
So, unless he's betting on the planet existing, as long as Earth is still here and country still exists, he's okay. So, he is the only guy I know who has the most locked in, foolproof portfolio, and he just has one stock, one fund, but it tracks every company on the planet.
Unless the fund manager that runs XEDT goes under because of some kind of stock scam, and then all 100% is gone. Because remember, we talked about diversity. One of the diversities for me is diversity of of fund managers. I believe you should also have fund manager diversity. So,
you know what? That's something I really started considering. So I own VFE because I went Vanguard because I was like, man, they're too big to fail. I think XQT is BlackRock, right? I think it's BlackRock. I'm like, you're kind of like, those companies can't fail because they basically just run America. Like, it's just like, there's like 3 large companies that just own everything. They're one of them. But you're meant for covered calls. These products come out so often.
Yeah.
I'm now looking at I kind of just need the fund to exist. As long as that fund is looking like, the reason why I think a lot of people invest in companies like Harvest and Hamilton, and I think I don't know, I'll speak on your behalf, but you can tell me if this is right. The reason why I got into Hamilton early on because they had a track record of being around for a long time,
right?
And through advertising, I was very familiar with them, right? Because I'd worked with companies like that.
Yeah.
And so I was like, all right, I know Hamilton will be here in 20 years. Like they're not going, well, I'm as sure as you can be about it.
Yeah.
So that was actually my key decision-making process of why I went with them and not anyone else. It was because I knew who they were and I knew they'd be around. Whether or not I picked the right ETFs to invest in first for my cover call, right? And ended up changing, but that's why. But now that I'm getting more deeper into this, I'm online with you now. I think a lot of my decision making will, a large portion will come down to diversity of funds. But for me, it's because I need to know, I don't know if they're going to still be here in 5, 10 years. The fund itself, like the actual company,
right?
Not so much the ETF.
Well, exactly.
People
you can
consider
never
that?
say never, because again, everyone says, well, and again, I'm using Hamilton and Harvest. Like, hey, great management team, very stable, very conservative, focused on making sure that NAV erosion doesn't happen, things like great company. But you can never say never that something doesn't go wrong with any one company. And again, look at Lehman Brothers. You want to talk about how many people put trillions or billions into something like a Lehman Brothers or something like that. And they basically turn around and said, oh, wow, I put all my money because they will never go bad. Well,
let's talk about that a little bit. I'm going to talk to you about something I've been thinking about. I've been pondering this a lot. So I got into ETFs. Like when I got into investing, I started with ETFs like a lot of people, and I started buying VOO. Eventually I just kind of consolidated into VFV but eventually I got into value investing, where my portfolio is single stocks. I'm making my own Gary fund.
Yeah.
Right. I have my fund of high performers and basically, and I outperform the S&P 500. That's what I do. So now I'm not worried about the fund going under. I don't care. I still have a ton of VFV just because I like having it there. It's nice, but I don't know. It's like 30% of my portfolio. The rest of it's just individual stocks.
See, and the nice part about that, Gary, is your mutual fund is diversified because you're picking different individual stocks. If you bought AT&T and AT&T went down, AT&T was just one of your holdings of several holdings. Like at the end of the day, you've diversified your mutual fund because you are the fund manager and they are your holdings, right?
Yeah, and I have similar rules to you. Like you have 5% rule and all that kind of stuff. I'm overexposed in some, just like everyone is, but for the most part, I stick to my rule. But the thing is, I have full control and I have the Gary fund. Right? When we do covered call ETFs, we're now relying on the fund to write the covered calls for us. We're paying them the management fee on that. You're in the you're at the whim of the fund.
Right.
I was thinking my natural progression, just like everything is, I go from ETFs, have them do it for me. I figure out how it works, and then I start doing it myself.
Right.
So my thing is, and I legitimately only locked in, I'm going to do this now, and I have a small percentage. I'm going to learn how to write covered calls myself.
Right.
And I'm going to start managing my own Gary Gill covered call fund.
Yeah.
And do the same thing that I'm doing with my growth portfolio, which means still have a locked in amount from ETFs like VFB and a couple other ones, which are nice. That's why I'm building this really nice portfolio here. But I'm going to have this other fund that I have, the Gary covered call fund, which I'm doing myself, and I'm treating like my value investing. That's my personality wise. I like to be hands-on. I like to be really hands-on. I'm going towards. So now my risk is going down. Technically, my risk is only myself now. Make sure I do my proper research.
The risk isn't going down. It's focused on you controlling it.
And I'm good at what I do. So I have more confidence in myself than I do have a fund manager.
Yeah.
And your confidence comes from a historical track record. I've been doing it for long enough, and I've overperformed for long enough. So I know what I'm doing.
And and I totally recommend that. I would say that that's a good approach if you are active and knowledgeable and you really feel confident to do it. I would not recommend anybody that's just an average investor. Like writing covered calls is not, you could learn it and you can become good at it. But if you don't really know how they work, it's best to let an expert do it. And that's the nice thing about fund managers, because they know how to do it. They have the team. They know how to watch it carefully. So again, unless you are an expert and want to actually actively learn to do contracts, it'd be best to let them do it, right? So
I can do it because when I'm not spending time with my family, friends and stuff, my time is it's in the investment space in some way. I don't want to get into it, but every part of my life is weaved into this. So that's why I can do it. Yeah. So that's a natural progression for me. So it's taking the power of the fund's hands. Have you ever considered that? But I feel like you're as close as you can do because you're so diversified in you have, I don't know, 29 holdings here.
Yeah.
It's like, you're like, the only extra step was like, you're right there, but you're like, but still don't want to do it myself. But
Yeah,
you're
I feel
right
like
there.
I feel like I'm if you talk about a company, I feel like I'm the vice president and I've got operations managers all over the place. It's like
That's what it
you
is.
make sure that works for high yield, you make sure that works for my
That's what it
low
is. Yeah.
yield. I turn around and it's like I sort of, again, we talk about what the P stands for in passive income investment,
Passive.
or
That's your passive.
PII. I like more the middle level, like more a little on the proactive. Someone like an Adriano type of portfolio tends to be on the passive side of it. And then there's those that say fully active. And that would be the ones say, screw them, I'm just going to do it myself. So I agree. I'm in the middle. I'm at that proactive income investing. So
I'm a man of extremes,
yeah,
always have been my entire life. So I'm going to be fully passive with this,
yeah,
and then also fully active.
right. But keep them
In my
separate.
completely
Yeah, keep them
separate. They don't
separate.
even talk to each other.
Yeah.
And then same with my growth investing, it's fully passive and it's
Right.
fully active. I
Right.
don't have a middle ground for any of these, just
Right.
because that's just how my brain works. I like to have some part I don't think about that just operates, and then I have a part that's hyper focused. And typically hyper focus is where I supercharge my gains. Right.
Right.
That's how I in my brain.
Right.
I don't know why I said that. I felt like sharing that little thing I'm doing.
Anyway, sorry.
Okay, so go ahead.
So yeah, ULTY is the one. I've already explained that one. It's a very small position. LFGY is actually a favorite of mine in the YieldMax weeklies. That's why I've actually kept it. It's actually a low priced right now. It is basically all focused around crypto technology. So it's not
Oh,
just Bitcoin. It's literally an ULTY for crypto, if you want to talk about that. It all focuses on like if you look at their underlyings, they hold a lot of crypto oriented underlyings. And so I've done that because it's a little bit, first of all, it's weekly, whereas Coney and MSTE are not there. You're only getting onto strategy or you're only going on Coinbase. LFGY A is weekly, B includes them all in it and basically is more of an all-in-one for crypto. And it plays weekly, and it plays a pretty good weekly, monthly yield. So I actually hold it because, again, it's down right now. So, but I do like it. I'm actually a pretty good weighted in this one.
so it's technologies within the crypto space.
Yeah,
It's not actually a coin.
it's not the
So that's
Bitcoins
interesting.
themselves. It's the technologies, I think, that drive it.
So that's interesting. So when I mentioned way earlier 10% exposure to crypto, I in my brain originally kind of thought it was 10% exposure to the crypto space, not just coins and stuff.
Well,
So I
LFGY
thought,
is a good candidate for that. It's in the
yeah, because
crypto
it would add
space.
diversity.
Yeah,
Because
it would.
that 10%, I feel like crypto is a portfolio within a portfolio. How do you
Yeah.
construct your crypto allocation?
Oh, yeah. Yeah.
Some of it's in directly maybe holding the coin, some of it's in holding a covered call, some of
Yep.
it's holding the technology surrounding it.
It is.
And I'm new in it. I only
Yeah.
literally MST is my only position, but I think that's interesting. I'm going
Yeah.
to earmark.
You should earmark that one because if you want something that's more diversified and broad spectrum inside the crypto space, LFGY, it's my choice. Again, there are competitors to it. I don't know what they are, but I actually hold a 6% position target on it. It's at
Yeah, you have a large
5.4.
position.
It is actually one of my largest positions right now inside my portfolio because it is an all-in-one. In my opinion, it's an all-in-one for crypto. And I like it, and it pays weekly. I make $4,500 a month off of him in monthly distributions. Its yield is currently at 74%. So,
How has its NAV been? Is it
uh,
staying within its range? Basically, now when I ask about NAV, a better thing is does it stay within its
it's
range? Its
definitely in
price
its
box.
price rate. That's another reason I like
Yeah.
LFGY. I'm looking at it right now. It's had lows of 32. It's had highs of 44. There was a point where it dropped. Like if you look further down than 6 months, I only use a 6 months window, but if you look further down, it was in the 49, 48 price dollar range for a while, and then it really dropped down into the low 40s. Since then, it's actually stayed in the low 40s and 30s. So if I had to give it a price box, I'd say the price box for me is 42 to 34, 33. It's actually was near that bottom. It almost hit the 6 month low, but it's actually coming back up again. Let me see. I bought it at my average cost is 37 US and it's currently at 35. So it's a little below my book price, but it definitely is one that has a price box as opposed to an erosion. So
You're getting 4,500, you said, a month from it?
the 40, let me see here. I'm getting 4501 out of it every
Damn,
month.
That's really good.
Which is better than my average, because I also do my spreadsheet. I track 6-month distribution average, because I always want to know, because you know, with the ultra yielders, their yields are going up and down all the time. So I always want to compare what the latest distribution is to its 6-month average. It is one of them that's actually paying above its 6-month average. It's my 6-month average for my distributions is 41, and it's at 45. So it's above my 6-month average right now on its monthly pay.
Okay, so that was
LFGY.
Okay, where are we? Yeah, LFGY. We did ULTY.
Yeah.
PLTY is Palantir, I'm assuming.
Yeah. So let me talk about these last ones. They are all, call them all in the same group. So if you understand how YieldMax works, YieldMax monthlies, or their traditional covered call ETFs, which showed up about 2.5 years ago, they had a whole bunch of them. There was this push by the community, by the investors, that said, we want weeklies. We want weeklies. We want weekly pay. Well, you can't turn these monthly ETFs into, because they're not zero DTE. So they can't actually do weekly pays. So what YieldMax did, and it was pretty innovative of them, they took old dogs and made them do new tricks. What they did is they said, okay, we've got, I'm going to say 30. We've got 30 of these ETFs. We've got MSTE and covered call all over the place. What we'll do is, if you invest in a bunch of our stuff, we will put them into 4 groups. They're called Group A, B, C, and D. And they took top dogs of, like, amongst them all, they got some top dogs. They got Coney, MSTE, AMZ, those that are in there. They spread those, and Tesla, they've spread those amongst the 4 groups. And then they added the rest of them into the other groups. So they're like 4 even groups. They all pay monthly, but they all pay on their own week. So week 1 is Group A, week 2 is Group B. So if you hold an ETF of each one of those groups, you get paid monthly. So
that is so funny. That is marketing 101.
That's
Jesus
marketing
Christ.
101. And it works, because with me, if you now look at the ETFs I hold, I make sure that there is one of those ETFs in every week of every one of those groups. Now, I've now got a hole in my strategy, because I finally dropped YBIT, there was an ETF that was in Group A. It was the only ETF I had in Group A. So I'm now going to be 3 weeks and 1 week off, 3 weeks and 1 week off, because my Group A will not have one of those pairs. So AMZ and MSTE, I'm just looking at which one. AMZ and MSTE are part of Group D. NVIDIA and Pleiade is part of Group B. And HUI and Coney are part of Group C. So those are the 3 groups, and I get paid every week now except for one. And that's why I have them. I have them so that they sort of blend into that 4-week cycle that they've created.
It's Palantir, Amazon, MicroStrategy, NVIDIA, HUI's, that's Robinhood, right?
That's Robinhood, and Coney is
Coinbase.
Yeah.
Oh gosh darn it. That's so funny. Yeah, there's that's such a good solution though, isn't it?
It is, because they couldn't make weeklies. So it was a really good idea for them to figure out, how can we do this in a way that we can give them weekly, but we can't turn them into true weeklies. So they did it that way, and people sort of groaned at first, saying, yeah, that's not a real weekly. But it worked.
But they upsold you.
To it now.
And they upsold you. That's marketing. You're always trying to upsell. You got people to buy a package deal.
Yeah.
Rather than buying one, you now have to buy the package.
Well, it worked for me, because I turned around and said, Coney doesn't have a sister. So all the others had 2, and Coney only had 1. So I bought HUI because it was actually a sister to Coney. So I ended up buying HUI. So
they created a bundle within stock picking.
Yes, they did.
It is so crazy. Has anyone tried to copy that?
Nobody has done that, because they've all turned around and just delivered on weeklies. YieldMax YieldMax just said, you know what? I can't change the old dog, but I'm going to make a new trick out of them. And so they did a really good marketing spin on that one, and it works. So, yeah.
Okay. So that is everything. That's the entire portfolio. What did we just recapped your 50 something $1,000 portfolio here. What was it? It's 50. I have $53,047. Your $1.6 million portfolio, more than that. At this point, we went through Hamilton, Harvest, Evolve, Global X, Roundhill, a little bit of NichoCrypto, Defiant, and YieldMax. What I'm interested in is so like for you, like we talked a little bit about it, what kind of investor were you before this? Did you say you did mutual funds? You went from mutual funds straight into this?
Yeah.
That was the gap you filled? That's like going...
I so
That's crazy.
I was like your typical average Canadian investor. Basically, I know I had to save for my retirement, so I went to my large bank and basically started contributing to their balanced portfolio. We're getting that beautiful 6% yield, annual ROI and stuff like that. But it bothered me because I actually did investing as a teenager, like in 19, 20 years old. I did penny stocks. And so I did have the itch to do my own investing. But I let it go and I just said, just give them the money, just give them the money. So my RRSPs just kept on building up and my TFSAs kept building up. But it bothered me because I was like, how am I going to retire with a 7% yield on these kind of
Yeah.
things? And I finally decided my retirement, I knew my retirement was coming up. I decided in 2022 that I said, you know what, enough of this. I want to try to see if I can do it myself. And it's funny because I've listened to some other people that you've interviewed and Mo has interviewed and Ari and stuff like that. And they all sort of say the same thing. Like if I actually listen to Adrian's history when he talked about it, it's like, oh my God, it's literally what I did. He just did it 4 years earlier. I took
Yeah.
the bull by the horns. I said, I need to do income investing. I don't want to do growth investing. So I started buying the same stocks that all, Paul and Adrian and everyone else bought. I started buying Enbridge because it had great dividends. I bought Suncor
Yeah.
because it had great dividends and TELUS, but the stock was up and down and I wasn't succeeding. I was like, man, this is all this is. And again, the thing that changed everything for me was I wasn't succeeding, and I was only a year away from retirement because this was 2022. I retired in October of 2023. And then January of 2023, I was here doing my work because I was still working, and my TV showed BNN said, "Hey, this HMax from Hamilton gives you 13% yield." I was like,
Hmm.
13% yield. What the heck is making 13% yield? So that sort of triggered my path towards this. I was like, I started investing and interested in it. I actually was like you. I turn around and say, I don't turn around. Oh yeah, they're just returning your own money, rock problems, all this. I actually don't believe things until I've learned it myself. I don't believe what I hear on social media. I'll use it as triggers to say, maybe I should research if that's legit or not, but I won't just
Yeah.
take it and believe it. I actually called the fund managers at Hamilton and had a half-hour conversation with them. And I said, you tell me the answers to these problems, like this rock and stuff. And that's where they told me there's a difference between good rock and bad rock. And they
Yeah.
explained that one's for tax purposes and one is legitimately bad rock. So they eased my mind enough that I said, hey, you know what? I'm liking this. So I learned a lot more about covered calls. And of course, I started the hunt for them. I found, HDiv and I started investing in them. And of course, once you do that, you know how social media is with regards to YouTube. Once you start Googling things start showing up. And that's where people like Adrian's passive income investing channel showed up and others. And
Yeah.
I won't say they inspired me to do my portfolio, but they helped validate that the direction I was going on was not crazy. So they gave me the confidence that this is not crazy. You've got people like Adrian that's doing it. So why can't I do it? So they validated that I was heading in the right direction. And like you on extremes, once I get an idea, I'm a dog with a bone. I literally, from February 1st, when I bought my first HMax cover call ETF, by November, all 6 of my accounts were converted to my portfolio,
Wow.
and my pension was commuted and moved into my portfolio, into my LIF. So I went from zero to full on this strategy in 10 months.
How's life been since?
Oh, it's people say this all the time. It's a game changer with regards to my lifestyle, with my retirement lifestyle. Again, I live a modest life. I'm not one that goes by Porsches and stuff. Honestly, my portfolio is not that big because people are like, oh yeah, it's 1.6. Think about anyone that is retired. If you add your pension value and your retirement investments and all that stuff, the average Canadian that has worked their entire career will likely have a portfolio around $1 million. So it's not as if my portfolio is this big, super rich lifestyle of the rich and famous. It's just I'm using these covered call strategies as a way of super juicing and extracting more income out of that same portfolio than if you would have been a growth portfolio where you just would have said, I'm just constantly watching it. Well, as a retiree,
Yeah.
I can't live on growth. I got to live on income. So this strategy has been great. I went from before the strategy, like if you bring me back to 2022, I was on the verge of retiring. It's like, how are we going to make it work with $5,000 a month? Because that's all I was going to get out of my balanced portfolio. And now I can easily live at 10 grand and still give away stuff to my daughters for help with their TFSAs. And I'm still growing my portfolio, not eroding it, which they talk with growth portfolios. They say they have to melt them down because you have to actually convert them back to cash so you can live off of them. Well, with mine, I'm generating more than I need. And I'm actually have a portfolio as I'm retired that's actually going up. Like,
Yeah.
I'm okay if it even goes down, but it's actually going up while I'm earning more money than I need. So it's been a life changer for me. Yeah.
Have you been noticing you're doing a little bit more stuff for yourself, that you have this extra
Yeah.
income, maybe more vacations with the family,
Yeah.
treating the wife to more things?
Yeah, you're right. Like, for example, like we did a major kitchen rental. And who does a
Yeah.
major kitchen rental when they're retired? Like, this thing was like
Yeah.
$50,000-$60,000 kitchen rental. So I would have turned around and said, okay, if we're going to do a kitchen around, like the before me versus the after me, the before me
Yeah.
says, maybe we could replace the counters and maybe retouch the
Yeah.
the cabinets. The after me was, no, do it all, cover it, get rid of it. We've got the money anyways. In 3 months of distributions, I paid for the entire renovation. And the old me would have never been able to afford that as a retiree. I bought a hot tub so I can enjoy in my retirement. We're going on a few more trips. We haven't gone on much. We're going to do some bucket list items on going on more trips. And more so, the other thing is giving my daughters financial independence. So making sure that they are set with their goals. So those are the things that have changed my perspective on spending, but none of it is like I'm spending it to go buy Porsches and stuff. It's modest living, but I'm being able to help the people I love as well. So
Reduce stress and peace of mind.
absolutely. Like, I don't go to bed at night worrying about my finances, which is one of the biggest stresses people have, no matter if they're not retired or retired. You're right. Peace of mind knowing that if I want to do something, I could do it if I wanted to. Yeah.
Especially in retirement. Like, I think I'm at an age where I can take on more stress. So I go, I'll work through it.
Yeah.
Right. But if I'm retired, I work too hard at that point. Don't give me stress anymore. Let me coast.
Yeah.
Right. Like, that's like, I don't want to do it anymore.
And
like, I already know myself.
Yeah, you're right. And the thing is, again, every individual is different, but with me, I'm the Energizer bunny. I can never just sit around and do nothing, even retired. So now, yeah, I'm retired, but now I'm a full-time YouTube content creator, something I never even thought I was going to be. Like, it still boggles my mind that I'm actually deemed an influencer in Blossom. Like, I never would have thought that. I only came to Blossom so I could talk to other people about, my wife and my family around me don't give a crap about investing. It's like I'm talking to nobody. I felt alone. So I went on Blossom so I could talk to somebody. And from going from that to like now I'm considered an influencer, it's humbling and it's surreal and now it's a new job for me. I'm like full time on this. So
you retired and became a social media influencer. That's good. What is your, you say like, I'll let you go in a bit. You've been really gracious with your time. But what does your wife and everyone think about it? Cause like first off in investing, no one in my circle cares about investing. Like I said, my family, my friends, like I'm the guy who knows everything about investing. I try to get them to invest, but they're kind of like, whatever. They don't care. Even my good friends, I've had the same friends forever. They're like, whatever. What do they think about this new part of your life? I'm sure they love it. They're probably happy to see you thriving. You get so much love online. I'm sure everyone like you're, even though they might not understand it, I think they're like happy you're doing something you enjoy. I'd have to assume.
Yeah. My wife was nervous, but I have to give her a ton of support because honestly, this was scary for her, especially when the biggest thing that scared her was only 10 months into going from zero, meaning what the heck is a covered call, to November saying, let's commute our entire pension and go all in on this. I have to give her a lot of credit. But again, I understood that she would have been very scared doing it. I mean, most people would be. You're giving up a pension, right? So if you could actually see in the very corner, I'm going to try to point up to it right there. See that? Is my finger show that? You see the whiteboard behind it?
A little bit closer to your face. I can't see anything.
Okay. No. So there's a whiteboard behind me. It's covered up.
Yeah.
It's still up there because I think it's going to be there forever. I wrote because I knew that would scare her, and I don't blame her. So I literally wrote, because the analytical side of me say, let's talk this through. Let's walk all through all the pros and cons of should we or should we not commute this pension. And so we walked it through, and I asked her, what are the concerns? Here are some of the things. Here, if we stick with the pension, the good part is we'll be paid $2,000 a month for the rest of our life. You know, the bad side is we're 90 years old. We're still being paid $2,000 a month, which effectively after inflation is about $600 a month. So that's the bad side about if we don't commute. So we really talked it through, and I have to give her a lot of credit. She believed in me enough to say, let's do it. And now she's gone from 2 years later. It's like, she's not scared about it at all. It's like the best thing that ever happened, but she was happy.
Yeah, you just handle that, honey.
You just, I'm
gonna go buy this thing now. You go do that.
Yeah. I'm gonna spend your money, but she's actually really good. She doesn't do that either, but we're both quite frugal people. So
yeah, same with me and my wife. We're really frugal. We both come from me and my wife come from pretty like humble, really modest lifestyles. Yeah. One thing when you're kind of talking through, like it's such a large shift. You're going from mutual funds to this. You're transferring everything over into this, and like I'm going to anchor a little bit more on your wife because it's a partner. When you're in a relationship, it's to you. It's not just you.
Yep.
It speaks a lot to like when you're talking like strength of your marriage, trust she has in you. Because God damn it, that's scary. So like when I go, that's like good. If you're looking for like proof of like, oh, someone has a good marriage and they have trust within their marriage, it's like that's a massive decision. That must have felt good. I'm just thinking if I'm you, I'm going, wow, that's good. And I definitely feel a sense of if like my wife she's showing me this, that's why I know. I know when my wife has shown that sort of faith in me, I've always felt I'm going to make this work now.
Yes. I'm going to make this work. Yeah.
No matter what, this shit is going to work.
So.
Yeah, because this person has faith. Like they don't even understand exactly what I just said. You want to walk her through, but she ain't going to understand the details of what you do, no matter what.
She still sees that it's scary. So.
Yeah, exactly. But I'm sure she appreciates that you laid it all out there. But it's just like now it's on you. I think there is that sense of like, as soon as she's like, go for it, you're like, well, we're done. This is going to be successful no matter what. I'm not moving until this thing delivers on what I promised.
And it's funny you say that because you said that once she believes in you and says, I'm putting all my trust in you because this is our family income. So I'm putting all the eggs in your basket. It actually influenced my portfolio too, because my portfolio, do you want to know why I'm highly diversified? It was mainly because I wanted to offset and mitigate as much risk as possible, because you always worry about what happens if you put all your eggs in one basket and it goes down. So the reason I have 20, 30 cover call ETFs is because I know that 2 or 3 of them can literally disappear off the face of the earth. And I know my portfolio is still protected. And I did that because that was her number one fear, is I don't care about the income as much as we need to make sure we can live for the next 20 or 30 years. So my portfolio is very strongly influenced because of her concerns that she didn't have to say it. I knew I had to mitigate those risks. So
100%. That's changed my investing style as well too, because it's our income depends on decisions that I'm making. Also, we both have children, and there's like, you're helping your kids out with their TFSA. I'm building up my kids have a bunch of stuff that I'm doing for them.
Right.
So a lot of like it. I think me and you would be much riskier investors if we just had.
Yeah.
If it was just me and you, though, if we were only looking out for ourselves, our portfolio is constructed very differently.
It very much
when you have,
but
like
I look at it because before we commuted the pension, I already converted my RRSPs, all my RRSPs. The funny part was all of them only had about 10 or 15 holdings. When I commuted the pension, it has to go into a LIF. That LIF instantly had 24 cover call ETFs in it. It actually focused a lot more on the conservative side, like call and bank and BKCL and HYLD, whereas the other ones were actually being more risky and going after the more higher aggressive stuff. So the pension switch was an example of the me that would have been without her versus the me that has to be with her. So
yeah. All right, we're gonna get going now, but I kind of want to know what can we expect from you in the future here? Because I'm looking at your YouTube channel. How often are you posting here on YouTube? Pretty often now, right? Twice a week.
Pretty often, but I'm going to turn around for those that were interested. there's a lot of passive income and income investing YouTube channels, and there's a lot that are cover call oriented, like what's the latest. If you watch my YouTube channel, you're going to see mine has a different slant to it. I'm actually focused more on income strategy development and focusing on the big picture, helping. If anyone comes to my channel, they're going to more be learning about how do I build a portfolio and a strategy that's going to last me forever. I don't even focus much on ETFs. That's why I warned you before this interview. Don't ask me too much about my cover call ETFs because they're just assets in my strategy. So if you look at my portfolio, my YouTube channel, you're going to see that. Now, that being said, because I actually develop like PowerPoint presentations and I actually have to think through entire strategies, it's not like an interview where I just have to put them in front of the camera and do this. It takes me 3-4 days to actually come up with a new video because I actually have to build the whole thought process behind it and mature it and fine tune it. So if you come to my channel, you won't see YouTube videos from me every day. You'll likely see one maybe every 3 or 4 days. But my hope is, and so far it's been showing because my viewership has just skyrocketed. People are liking the long videos that are explaining to them strategy, and that's what you're going to get from me.
Yeah, and they're dense. Like through every 3 to 4 days, it'll take. I don't think people can even consume it fast enough because it's like dense. They got to then digest it, probably go back, give it another rewatch. It's like you got to give people 3 or 4 days just to like take it all in.
And that's funny because I've had several viewers saying they've watched my video 2 or 3 times because they're trying to pick up. They're actually using my videos to develop strategies as opposed to picking stocks. I've had several of my followers and subscribers say, well, Perry, what stocks would you buy if you were an American and stuff like that? And I'm like, honestly, I can't really tell you that. I'll try to work on that, but I really don't worry too much about anything that's not inside my catalog. You're going to more learn on why do you diversify? How do you do a rebalancing structure? So it's more like how do you manage and maintain it, not what you have in it with my channel.
Yeah, you're teaching people how to fish, not just giving them fish.
You nailed it. I'm teaching how to fish. And that's what you're going to get if you come to my channel. You're going to teach how to fish, not what you're fishing with. So.
Well, let's end it there. Everyone go fishing with Perry. Check out his channel. It was fantastic talking with you. We will talk soon. I appreciate it.
Thank you very much. And I thought it was a very good conversation. Enjoyed it very much. So
I had a blast. Thanks.
All right.
Talk soon.